Good afternoon. Good afternoon, James sir. Good afternoon, all dear aspirants.
Good afternoon, sir.
Good afternoon, sir. Good afternoon, sir.
Morning, our 2 sessions are over. Foreign exchange 2 hours and risk management 2 hours. In continuation of that, we will be commencing treasury management right now. 2 hours. Treasury management will be continuing, and in the evening, balance sheet management also, as you know, it will be there. So today the class is being taken by our one senior faculty, James Jones sir. He is a retired chief manager from Indian Overseas Bank. So we'll be commencing the class now itself. My best wishes to all of you. Only one more day left for the examination. I'm sure that all of you are prepared very well, and this class will be helping you to brush up whatever you have prepared, as well as any doubt is there, that also can be get clarified during the day. So best wishes once again, and I welcome James sir to commence the class. Sir, please sir, now it is over to you.
Thank you, Mohan sir, and hearty welcome to all the participants. This particular session is exclusively meant for numericals from treasury management. So the purpose of the session is to reinforce what you have learned in till now. So I'll be repeating the numericals which we have discussed earlier, and you can have your doubt. Only see, I will give it time because the participants are more. So please kindly avoid raising your doubt in between. Each topic, I will be touching the numericals mostly. Say number one, treasury bill, a very simple calculation, interest calculation. Then war, how we calculate war. Then options, numericals on options. Then bond valuation and YTM duration, and at the end futures. So these are all the probable areas from where you can expect a numerical question from theory from treasury management. Fine. So I'll go to the topic. The first, I'll start with treasury bill. Let me share the screen. As you know, what is a treasury bill? Treasury bill is nothing but a debt raised by the government of India. Whenever government of India, our central government, wanted fund for development purpose or for a budgetary requirement, they go out for a collection of funds from the public, and for that purpose they come out with a issue of a treasury bill. So here, so these are all the topics I want to cover: treasury bill, war, bond, options, and futures. Just to brush up your ideas, let me repeat what is meant by treasury bill. It is issued at a discount, important, and on 3 maturities it is issued: 91, 182, and 364. This is issued by government of India. So the fund which has been collected from issue of the treasury bill will be enjoyed or will be utilized not by Reserve Bank of India, by government of India. So it is a borrowing by government, if I make it very clear. And this has been issued in two types of auctions are there. One is uniform price system or uniform price auction, also known as Dutch auction, and a multiple price auction or multiply system, that means French auction. You must be knowing what is uniform pricing. Whoever bid for a particular auction, entire applicant will be allotted the treasury bill at a uniform rate. That is called a uniform price. Whereas in the case of multiple, it is multiple. Whoever has opted a higher rate, means for 100 rupees, if they have, somebody has opted for auction for say 99 rupees 50 paise, another 99 rupees. So who had an auction for 99.50 will be allotted. So that is multiple price. So there, that is the basic difference. This multiple pricing is also called French auction, and this is secondary market. This is actively traded, and that is being taken by CCIL, Clearing Corporation of India Limited. They are doing the settlement of treasury bill in the secondary market. Now, who are all the participants who can conduct this auction, who can join this auction, for participate in the auction? Any person. See, that means even individual. primary dealers, banks, mutual fund, everybody, corporates, other business entities, and even individuals can participate in the treasury bill auction. The only thing is they should maintain an SGL account. What is SGL account? Subsidiary General Ledger account. This is maintained by Reserve Bank of India for putting through the government securities. That is SGL account. And here the tenors are 91, 182, and 364. And their frequency is also very important. There can be a question. 91 days is auctioned every week on all Wednesdays, whereas 182 and 364 are on fortnightly basis. Or 182 days treasury bill means the tenor is 182 days. That treasury bill is auctioned on the Wednesday preceding the non-reporting Friday, and 364 on Wednesday preceding the reporting Friday. Make it very clear. So these are all the things fortnightly, 182 and 364 on fortnightly basis, and 91 days on weekly basis, all on Wednesdays. Now, next is CMB, cash management bill. What is the difference between treasury bill and cash management? All the generic features of treasury bill will apply to cash management bill except one, or you can say two. Number one is the tenor is below 91 days. So remember, treasury bill can be issued for three maturities: 91, 182, and 364. And in some cases, the government, central government may require a fund for a shorter period, less than 91 days. For that purpose, this cash management bill has been introduced. So if they wanted a fund, they wanted some funds, 100 crore, 1,000 crore, or 50,000 crore for a short period, less than 91, they can come out with a cash management bill. So there is no definite period is not there. As and when government required fund, they can come out with an issue. And how do the public come to know? By a separate press release. So a separate press release will be given by Reserve Bank of India 1 day in advance. That means if tomorrow Treasury RBI is coming out with a cash management bill, they will come out with a press release today with the amount. They will say 10,000 crore CMB we are issuing tomorrow, and the tenor is say 45 days. So then public will come to know, they submit the bidding. And here the second difference is it is competitive bidding. That means non-competitive bidding is not applicable. That means it is multiple pricing system. So that these are the two differences. Otherwise, one and the same thing for qualifying in SLR purpose, MSF, reverse repo, everything, it is the same. Okay. Now, you must be having some doubt, this reporting Friday, preceding and all. So look at this calendar. It will be very useful for you to remember the concept. See, I told you 91 days on all Wednesday. So if November is the November 2021 November calendar is before you, here all Wednesday comes 3rd, 10th, 17th, and 24th. So the 91 days treasury bill will be issued on all these 4 days. Coming to 182 days treasury bill. See, here I have marked in red 5 and 19. So these are all the reporting Fridays. As you know, every bank, they have to report their position, their demand and time liabilities for the purpose of computation of CRR and SLR in a fortnightly basis. And this fortnightly basis started long back since its introduction. And the 5th of November is a reporting Friday. So the 5th of November is one reporting Friday, and the next reporting Friday for the bank is 19th of November. So this 19th of November, all the DTL, net demand and time liabilities for the previous one fortnight. That means from 6th of November to 19th of November, they will report. Therefore, 5th is a reporting Friday, 19 is the next reporting Friday, and the next reporting Friday is in December. It is 1 to December 3rd. 3rd will be the next reporting Friday. So you know what is a reporting Friday. And now coming to, say, if 5th is a reporting Friday, which is the preceding Wednesday of the reporting Friday, 3rd and 17th. So 3rd and 17th are the days on which this 364 days treasury bill will be auctioned. So Wednesday preceding reporting Friday. And what are the non-reporting Friday in November? 12th and 26th. And what are the preceding Wednesday, preceding Wednesday of non-reporting Friday? It is 10th and 24th. So 10th and 24th are the days on which the 182 days treasury bill will be auctioned. Fine. Now we will move on to a numerical. A 182 days treasury bill is auctioned at 96.5. What is its implicit yield, or what is its effective yield, or what is its annualized yield, or what is the discount rate? Everything one and the same thing. So remember, in the beginning, I told you treasury bill is issued at a discount. That means if the value of a treasury bill, face value is 100 rupees, they will issue at a discount. That means whoever comes out winner for this auction, and suppose they have opted 96.50, that means they have to pay 96.50 for one treasury bill, and they have to wait for 182 days. And on maturity, the RBI will pay, or the government of India will pay 100 rupees. This is the concept of discount. So issued at a discount. So here it is a very simple formula to find out the implicit yield. You can use the formula, simple interest formula, I is equal to P into N into R. Or here you have to calculate the rate of interest. And for calculating the rate of interest, it is I into 100 by P into N. If you want, I will do it in the whiteboard. Since it's a very simple one, I am not going for that. So here, what is P? A person who is investing in this treasury bill, he has to pay 96.5 rupees. So the amount which he is investing is 96.50. So here P is 96.50. And how many days he has to wait? He has to wait for 182 days. So number of days is 182. If you convert to year, this is 182 by 365. Next is I. What is I? The interest component here. You pay 96.50, you receive 100 rupees. So what is the income you are getting? That is what interest, or I say discount. 100 minus 96.5, that is rupees 3.5. So just substitute in the formula I 3.5, N 182 by 365, and P 96.5. You will get 7.27%. This is the way in which you have to calculate the annualized yield or effective yield or the discount rate of a treasury. Look at the second question. Same pattern. A treasury bill is trading in the market at 98,000. Because means this is a lot, one lot of treasury bill, 1,000 treasury bill is trading at 98,000. You know what is happening in the secondary market? The primary market, this is issued by Reserve Bank of India. Once a security is issued by Government of India or by RBI, then it goes to a secondary market. Whoever invests in, either they have an option, they have to wait for the maturity and then encash it by surrendering to Reserve Bank of India. And the other way is, suppose in between, a person had invested an amount in 182 days. After 100 days, he wanted some money back. What is the way out? He cannot go to RBI, give me the money, because RBI says we will pay you only at the end. So the other alternative for the person who is investing the securities, he can trade it in the secondary market, in the stock market. So he will go to the secondary market where he will sell his commodity. Just like we are doing share trading, this treasury bill is being actively traded in the secondary market. So here, please, here,
repeat the first one, sir. First one.
Mute your mic. Please mute your mic, participants. So here the question is, a bill is traded at 90,000, means this is one bunch of treasury bill, 1,000 treasury bill. So it is traded at 90,000, which has a face value of 1 lakh.
Excuse me, sir.
Yes.
Please repeat first one, sir. Please repeat first one.
First question. You want me to do it in the whiteboard?
Yes, sir. Yes, sir. It will be better, sir. Please.
No, sir. No more time.
That's it. That's the thing.
No, sir. No, sir. No, sir. Whiteboard.
No, sir. No, sir.
It's a very simple thing.
Sir, let's not waste time.
Let me.
Sir, continue, sir. Continue, sir.
See, here, the simple interest formula is P into N into R. So we want a rate of interest. Rate of interest, the formula is I into 100 by P into N. Here, a person is paying 96.50 and he is receiving 100 rupees. And he has to wait for how many days? 182 days. So what is this 96.5? This is the amount which is investing P, and he is getting 100 rupees. So here, what is I? 3.50, and this is N. You substitute here. This is equal to I 3.50 into 100 divided by P. P is 96.50 into N. N is 182 days. 182 by 365. And this 365 will come on the numerator. So this will come to the numerator into 365. You solve this. You will get the answer. Can I proceed? That's what I told you. In between, if you come out with doubt, then
yes, sir. Please proceed.
You can go ahead, sir. You can go ahead.
Okay. I'll share whiteboard whenever it is needed, because whenever there is some tough calculation, I'll definitely go to the whiteboard. See, in the second one, same thing. Here it is 98,000 is P. A person who has invested 98,000, he has to wait for leftover life. See, 85 days is the life of the treasury bill. That means this bill may be a 91 days or 182 or 364 issued earlier. Now the leftover period is 85 days. That means whoever invests in this bond, this treasury bill, they have to wait for 85 days. So the number of days, or here N is 85 by 365, that is year. And here what is I? Interest component discount. They have to pay 98, they get 1 lakh. So 2000 is I. And you calculate the same formula, R you will get as 8.76. We'll move on to next one. See, this is something connected with bidding. There can be a question. See, Reserve Bank of India has received the following bid for a notified auction of 10,000 crore for issue of 8% Government of India bond. This is maturing. Maturity date are not relevant for us. So here, these are the bidding made by various parties to Reserve Bank of India for this particular issue. Bidder A has bidded 100.85. And the bid amount is 2,000 rupees. That means this particular Government of India bond, for 100 rupees bond, face value is 100 rupees. This particular bidder A says, I will pay 100.85 now. Fine, because it may be issued some time back. So some accrued interest may be there, or the rate of interest will be much more than the market rate. That may be the reason they have bidded for 100 rupees. They say A says, I will pay you 100.85. B says, I will pay you 100.75. C says, I will pay per security 100.7. D 100.68 and E 100.60. So these are all the various bid amount or bidders they have opted participated in the particular auction. Now look here, the notified amount by RBI is 10,000 crore. These are all the individual. This put together comes to 15,000 crore. So RBI wanted to raise fund, or they wanted to sell this particular security worth 10,000 only. So how it will be allowed? And here, this is a multiple price auction. And RBI fixes the cutoff at 100.68. So that is, it is that RBI has got the privilege to fix at what rate this can be auctioned. Fine. So RBI fixes the cutoff date as 100.68, cutoff amount as 100.68. And this is a yield-based or a multiple price auction. So how much bidder D will be allowed? That is the question. So bidder A has opted for 100.85. Amount which he had bidded is 2,000 crore. So the entire 2,000 will be allotted to A, because this is multiple price or this is yield-based auction. Now coming to B, he has opted 100.75, which is also above 100.68, because the cutoff fixed by RBI is 100.68. So 3,000 will be allotted to B, bidder B. Bidder C, 100.7. That also above 100.68 will be allotted. So put together, how much it is allotted? 2,000 plus 3,000 plus 3,000. Put together 8,000. Now 8,000 worth the security has been sold. RBI intend to sell only 10,000. So the leftover amount is 2,000. And this 2,000
won't D be included in the think because it is also holding 100.6.
I'm coming to that. See, 100.68 is the cutoff, and D has opted for 5,000. If RBI allowed the entire amount, it comes to 13,000. But the notified amount is only 10,000. So for D, RBI will allot only 2,000 crore. Got it? This is what in multiple price auction or yield-based auction. Suppose it is a uniform price auction and RBI fixed it at 100.68, then it will be given 100.68 to all A, B, C, and D. So that is the difference between multiple price and uniform pricing. Now here there can be a question. See, the bidder A, B, C, D, E may not be single party. See, A means there may be some 5 or 10 people who had bidded 100.85, and that put together comes to 2,000. Similarly, the D means the people who had opted for 100.68, there may be 10 parties, A, B, some 1, 2, 3, 4, like that. And put together is 5,000. A particular person has opted for, say, 1,000 crore. How much he will get? That question also they can ask. Are you following me?
Yes, sir.
So it will be allotted in the ratio, in the same ratio, because how much is left? 2,000 is left. What is the bid amount? Total 5,000. So the 5,000 has to be distributed to 5,000 has to be in place of 5,000. They have to allot 2,000. So you have to calculate the percentage. What's the percentage? It is 40%. 40%. So if a person has opted for 1,000, he will get 400. Another person has opted for bidded for 500 amount, he will get 500, 40% of 500, 200 crore, like that. So a question in that fashion also, it can come. Am I clear?
How we will take, sir?
Because see, the percentage, the total aggregate amount auctioned is 5,000. But RBI has got only 2,000 to share, to sell. So what is the percentage? Total request is for 5,000, but they wanted to sell only 2,000. So what is the percentage? Into 100, 2,000 into 100 by 5,000, you will get 4,000 rupees, 40%.
Yes, sir. Yes, sir.
That percentage you have to allot. Now we'll move on to the next one, war.
Sir, previous question, if E is also 100.68, then what will happen?
E means that is included in the other one.
No, sir. For
so
D, it is 100.68. I'm asking for
E also 100.68. So 100.68 put together total how much? 7,000 crore. They have only 2,000. You find the percentage. 7,000. 7,000 into 2,000 into 100 by 7,000. Take the percentage, isn't it? See the total. See, very simple thing. You have say 10 chocolates with you. You have say 4 or say 5 children, and all the children I want 4 each. You have only 10 chocolates. How do you distribute? And you cannot have a partiality. You have to distribute equally. How much you will give for each children? You have 10 chocolates, 5 children are requested. Everybody is saying, I want 4 each. Can you give 4 each?
Sir, 2.
Yes. Same thing, same principle.
Sir, if it is uniform, then how we will give in this?
If it is uniform and if it is 100.68, then the total 100 points, suppose they are allotted for 100.68, they aggregate the total amount, 13,000. Total amount is 13,000. They wanted 10,000. So 10,000 into 100 by 13,000. That is a percentage. Isn't it? And everybody will get that share. If it's uniform pricing, everybody will be getting at 100.68.
Okay.
So then the bidder who has bid at 100.85 will be getting it at 100.68, sir.
Everybody will be getting, if it is uniform pricing, everybody will be getting at 100.68.
Okay.
Okay. This is war. What is war? It is a measure for a risk. To measure, how to measure a risk? That is war. It is value at risk. Remember, in this case of measurement of risk, there are 2-3 things. Number one, this is for a definite period. War is calculated for a definite period and for a particular confidence level. So these are all the two assumptions when we discuss about war. So there will be a confidence level. What is meant by confidence level? Confidence level is nothing but accuracy. If it is 100% confidence level means it is definite, it is sure. So you cannot have such a decision because now you are going for the exam. If your confidence level is 100%, that means you will pass the exam, isn't it? But if your confidence level is 90%, there is a chance of failing by 10%. That is the concept of confidence level. So here, generally, the confidence level ranges from 90 to 99. In any case, it cannot be 100 because this is only a prediction or this is only an estimation. Remember, so it's an estimation. It's a statistical tool, so it can go wrong also. Therefore, war is always calculated at a definite confidence level. And the question that will be given, whether what's the level, maybe 99. If it is 99% confidence level means up to 99%, the decision or the measure is correct. But there is an element of wrong or going wrong by the decision by 1%. 98 means 2%, it can go wrong. That is the meaning of confidence level. And next is, it is for a period. That period can be either 1 day. For 1 day, we say overnight. So today, the value of dollar is 72 rupees. Tomorrow, the value of dollar may go up by 10 paise. Up or down by 10 paise means overnight, this 72 can either go to 72.10 or it can come down to 71.90. That is the meaning of war. So it will be for a period at a particular confidence level. So this is the definition. What is the definition? It's a statistical tool. And for what purpose? To measure the risk. And it is for a given period of time at a defined confidence level under normal market condition. That is more important. See, if some abnormality comes, the measurements go haywire. There is no guarantee that even otherwise, it is only certain percentage will be there. But this prediction is under normal market condition. You must be knowing the pandemic has come all on a sudden in 2019 or 2020, somewhere in February, March. So before that, we were not expected of what is. So a lot of changes are taken place. That is an abnormal condition. So such situations can happen. So under normal market condition, over a period of time, under a definite confidence level, you can measure a risk, and that is called war. Fine. Now, here I'll give 2-3 examples. Number one, let me take it here. The first one is overnight war for Euro INR at 99% confidence level is 20 paise. And today's spot rate for Euro INR is 82.30. So let me do it in the board. I think that will be more clear for you. Let me do it here. See, it is given that overnight war for Euro INR at 99% confidence level is 20 paise. And today's rate, Euro INR, is 82.30. So this is today's rate. 82.30 is today's rate. And war is 20 paise overnight. That means tomorrow, the value of Euro can go either 82.30 plus 20 paise. That means 82.50, or it can be less than 20 paise That means 82.10. This is the meaning of war. I'll repeat once again. See, the war, today's rate is 82.30 for euro. 1 euro is can be purchased or sold at 82.30. Take any rate, buying or selling, whatever it may be. And here the war, the element of this rate going up or down is 20 paise at 99% confidence level. That means there is an element of risk of 1%, but up to 99%, the difference or the euro may either go up by 20 paise or down by 20 paise. If it moves up by 20 paise, the rate tomorrow, the rate becomes 82.50. If it comes down by 20 paise, the rate becomes 82.10. So this is the meaning of war. I'll put another example. 1 month war. This is overnight war. 1 month war for a stock at 95% confidence level is 25 rupees. And presently, this stock is trading at rupees 400. This means what? 1 month war. Here it is 1 month war. So that means next 1 month, the value of stock can either go up by 425. So it will be 425, or the value of the stock can be less by 25. That means 375. This is the meaning of war. So next to 1 month, this value of this particular stock, maybe MRF stock or some company's stock, now this is trading at 400 rupees and the overnight war is rupees 25, means next to 1 month period, this stock may trade between rupees 425 and rupees 375. So this is the maximum it can go and this is the minimum it can come. And the accuracy for this is 95%. So there is an element of 5% this prediction going wrong. Clear? We'll move on to the next one. Next one, I'll clear this. See, war for USD, another a question can be asked like this. War for USD INR at 95% confidence level is 50 basis point. War overnight. This is overnight. If the day closes at rupees 72, what is the worst possibility tomorrow for an exporter and for an importer? A question can be asked like this. Today, dollar is trading at rupees 72 and overnight war at 95% confidence level is 50 basis points. Remember, this is not 50 paise, this is 50 basis points. In the previous question, I have given you the war as absolute measure, 25 paise or 25 rupees like that. Here, this is basis point. Then you should know the relationship between basis point and percentage. 50 basis point means
0.5.
0.5.
0.5%. To convert basis point into percentage, you divide with 100. Or for converting percentage to basis point, you multiply with 100. Okay? 1% means 100 basis point. 0.5% means 50 basis points. Remember,
Sir, please repeat, sir, please, sir.
Basically, the relationship, I think this, so many occasions, this might have been discussed even by Mohan sir also. Basis point, the relationship between basis point, because in monetary policy announcement run, you must be reading the newspaper, where they will never say 2% or 5%. CRR has been increased or decreased by 20 basis points or 10 basis points, isn't it? So the relationship is Yeah, 1% is equal to 100 BPS. 1% means 100 BPS, or 1 BPS means 0.01 percentage. Or if you want to convert the percentage to basis point, multiply with 100. If you want to convert basis point to percentage, divide with 100. Clear? So here it is 50 basis point. 50 basis point means 0.5%. Now here the value of dollar is 72. Overnight war means 50 basis point. That means this tomorrow, that is overnight, tomorrow, the value of dollar can be either 72 plus 0.50% of 72, or 72 minus 0.50% of 72. Clear? So this you get, this is 72 plus 0.5% of 72. How much it is? 0.5% of 72? 0.36. Yes. 0.36. You will get 72.36. This gives 72 minus 0.36. This you will get 71.64. Am I correct? Therefore, what is the worst possible rate for an exporter? These are the two rates.
71.64.
Yes, for an exporter, this is the worst possible, and for an importer, this will be the worst possible situation. So for an exporter, the rate will be 72. Wrong. For an exporter, the worst possible is
71.
yes, 71.64, because he get only per dollar 71.64. Am I correct? So the worst possible situation is 71.64, and the most advantageous situation is 72.36. And for an importer, the worst possible situation is 72.36, and the most favorable situation is 71.64. Because favorable means he need to pay per dollar only 71.64. He need to pay less amount. Remember? So you think of an exporter which is favorable. For an exporter, the favorable situation is he should get maximum amount, Indian rupee, means the highest one. And the worst situation is the lowest one. For an importer, the worst situation is the highest, and the lowest, the favorable situation is the lowest one. Is it clear? Any doubt?
Yes, sir.
Sir, clear.
Yes, sir.
Yes.
Clear, sir.
Okay.
So whether the question will be asked in like a spread. Here the total spread is 36 plus 30, so total 72 paise. So whether the question will ask in reverse order, any chance?
I don't think reverse order. They don't ask. They will be in from war. This is the possibility, because as far as war is concerned, they will give like that. But reverse order mean overnight war. They will give. They may ask you to calculate a longer period war, or they will give you a longer period war. You will be asked to calculate overnight. That possibility is there. We'll do one question each from that also.
Sir, 0.36. How?
0.5% of 72. I'll give another example. See, 1 month war for GBP INR is 91.7580. At 99% confidence level is 10 paise. What is the worst possible situation for an exporter and for an importer for next day? So overnight war, this is overnight war. This is the spot rate. 10 paise is the war. Value at risk is 10 paise. What is the worst possible here? How this GBP moves? As per this prediction, tomorrow the value of GBP can be either, for in the case of buying, it will be 91.75 plus 0.10, or it can be 91.75 minus 0.10. That means it can be 91.85 or 91.65. So these are the two possibilities of what? The buying rate. Am I correct? Now coming to the selling rate can move from 91.80 plus 0.1 or 91.80 minus 0.1. That means it can be 91.90.
So that is 10 BPS only, no?
No, this is not BPS, 10 paise. Remember, the question can be in both ways. Here it is 10 paise. So it is 91.70. So these are all the buying rate can move from, or it will lie between 91.85 and 91.65. So which is the worst possible for an exporter?
91.65.
91.65.
Yes, 91.65. Similarly, the selling rate will be range. The range will be from 91.90 to 91.70. So which is the worst possible for an importer? 91.90. Is it clear?
Sir, we will buy at lower price, no sir, for exporter. 91.65 is okay, no sir?
No, see here, see the question is, you look at the question. As a banker's point of view, we buy at low and sell at a high rate. The question is, which is the worst possible situation for an exporter? Okay. See, here there is an exporter. Today, the rate is 91.75. Fine, the rate of GBP today is 91.75. But this particular exporter, he could submit the bill only tomorrow. So tomorrow, how the value of GBP can move? So you will calculate the VAR. The VAR says it is 10 paise. That means the buying rate can move between 10 paise. It can either up by 10 paise or it can be down by 10 paise. So today it is 91.75 is the buying rate. So tomorrow it may go by 10 paise more, means 91.85, which is favorable. Or it can come by 10 paise, reduce by 10 paise. That means it can come to 91.65. So tomorrow's prediction, this is tomorrow's prediction. That is what war. And for an exporter, which is the worst situation? That is the question. So for an exporter, he should get maximum. That is a favorable. And the worst situation means he get the least. Here 91.65 is the least he is getting. So the worst situation is 91.65. Similarly, for an importer, it is the other way. Clear?
Sir, here no relevance for this.
No relevance?
Confidence level, 99%.
It is there, 99%. It is given. It is there. The confidence level, always whenever war says, it is at a confidence level. They will give a confidence level. That means the prediction can go wrong by 1%. There is a probability or chance of going the prediction by 1%.
Okay, sir. Okay.
Okay. Sir, excuse me, sir. This confidence level, there is no significance of in calculation of this rate, no, sir?
Yes, yes, confidence level. See, we'll calculate another, how we go for another question where how we calculate war. Now here war is given. How do we calculate war?
Okay, sir. Okay, sir. We'll wait.
Yes. Look, see, there are three methods for calculation of war or computation of war. One is parametric approach, or which is also known as correlation or various covariance approach. Parametric approach or variance covariance approach. Next is Monte Carlo simulation method, and third is use of historical data. So these are the three methods used for calculation or computation of war. Okay, there are three methods. This you just remember these names, because here the numerical part may come only for parametric approach, because the other two, longer period, Monte Carlo simulation and historical data, it is a time-consuming procedure and it will not be asked in the examination. But you should know the methods. So these are all the three methods for computing war: parametric approach, Monte Carlo simulation, and the use of historical data. In Monte Carlo simulation, see, some artificial situations are generated, and from that they arrive at a decision. That is simulation method. And in use of historical data, a time series, they study a time series. Using time series, they study the fluctuation. For example, suppose they wanted to know the price fluctuation of say gold or say dollar. What they will do, they will go to the history previous for the past 1 year or past 6 months, how this dollar is traded or how gold is traded. So from that information, they collect, they come out with an inference or a conclusion. That is called the use of historical data. Fine. But now parametric approach, there is a definite formula and it is simple also. Here, the calculation of war, the formula is W into V into Z, where what is W? W represents the value. If it is, we are discussing about war of a stock, W is the value of that stock, that security. If you are discussing about war of a currency, it is the value of that currency, that is W. And V is the volatility, the how it changes, the volatility or the variance. And is that the standard normal variable? Here comes the confidence level. So the value of Z is the representing the confidence level. If it is 90% confidence level, the value of Z is 1.645. This is derived from the Z value, from the standard normal distribution. So that is statistics. Only mathematical students can be, they might have studied it. I'm not going in deep into it. Now just remember the bell curve. It is also called the bell curve or standard normal curve or Z value. So this Z, the value of Z changes with respect to change in confidence level. In the examination, they will give it. It is not possible for you to remember all the values. So these are the basic. Generally, they go for either 90% confidence level, 95% confidence level, or 98% or 99%. If it is 99%, the value of Z is 2.576. Otherwise, it is 2.326, 1.960, 1.645. Generally, they will give the value of Z. Okay, and now this
in questions it will be mentioned or it will be remembered?
It will be mentioned. They will give it, and if you can remember this, at least these 4 values, better. Probably the question will be either for 99 or 98 or 95, or at the most 90%, not more than that. Because there is no point in calculating the measure for 50% confidence level. No, there is no point. Just like you are going for the examination, isn't it? Those people who are not preparing and they will go for a war measure of 50% means they just go for exam and without preparation. If luck favors, they pass, isn't it? So there is no point. So generally, this is measured at 99 or 95 or 98 or 90%. Now here, one more formula, important formula is, how do you calculate the longer period war? When the overnight war is given, how to calculate the overnight or longer period war? For calculating the normal and the longer period war, it is overnight war into square root of n. A very simple formula. I will do a question. Overnight war in the root of n, where n stands for the period or the number of days in that particular period. And from this, you can even calculate longer period war also, or longer period volatility. Volatility and war are the same thing. So this formula you have to remember. Overnight war is equal to longer period war divided by square root of n, or longer period war is equal to overnight war into square root of n. Fine. Now look at a question. This is a question. 1 second, let me take it. A bank XYZ has an investment of ₹1 crore in the equity of a company. So a bank is holding the shares of a company and the worth of the share is 1 crore. So their exposure is 1 crore. The daily volatility in the value of the stock is 2%. Volatility is 2%. The variance, the change in its value is 2%. Compute the war at 99% confidence level for the following period: overnight war, weekly war, and monthly war. So these are all the 3 questions. Here, the value of Z is given 2.576. So 99% confidence level, the value of Z is 2.576. What you are asked to calculate, what is the war overnight? So the formula for overnight war, what is the formula? Overnight war, as per this approach, is W into V into Z. So W into V into Z. What is W here? 1 crore. What is V? 2%. 2% means 0.2. And what is Z? 2.576. Straight away, using the formula, overnight VAR is equal to W into V into Z. 1 crore into 2% means 0.02 into 2.76. 2.576. We'll get it as rupees 5,15,200. So what is the meaning of this? Overnight VAR is 5,15,200 means today the value of the stock is 1 crore. Tomorrow the value of the stock can either increase by 5,15,200 or it can decrease by 5,15,200. That is the meaning of VAR at 99% confidence level. Now, second question is, what is the weekly VAR? Here, number of days in a week is given, that is given. Therefore, weekly VAR is equal to, there is a formula, longer period of VAR is equal to overnight VAR into root of n. Here, n is 7. So, overnight VAR is 5,15,200 into square root of n, square root of 7. And square root of 7 is 2.65. That you can calculate using the calculator. So, 2.65. Multiply it, you will get 13,65,280. This is weekly VAR. And how do you calculate monthly VAR? Monthly VAR is overnight VAR into root of n. So overnight VAR is 5,15,200 into root of 30. Square root of 30 is 5.48. You get it as 28,23,296. This is the way in which we calculate the value VAR under parametric approach. Is it clear?
There is small doubt, sir. Here, this 99% confidence level, it is not used in this. What is the use of 99% confidence level showing here?
19% is used here because at 99% confidence level, the value of Z is 2.576. You look at the previous slide, 99% confidence level, the value of Z is 2.576. If it is 98%, the value of Z is 2.326. If it is 95%, it is 1.960. 90%, it is 1.645. Accordingly, the VAR, that means the range will be less. If it is 90%, it will be less than this 5 lakh. But the accuracy is less. Got it? If you want to calculate the value of the VAR at 90% confidence level, you have to take Z as 1.645. So here you use, instead of 2.576, use 1.645. Then this value will be much lesser, but the accuracy is also less.
Sir, one doubt. To calculate weekly, we take square root of 5 or 7, sir?
If in some questions they will give, they want monthly VAR and number of trading is in a month 25, then you have to take 25. Similarly, in weekly VAR, they say number of working days is 5 or 4, then you have to take 4 as here. Otherwise,
it's not mentioned about the days.
Then you can take weekly as 7 and monthly as 30 days. Okay. Look at another question. The overnight VAR for Forex open position of your bank on a given day is 10 crore at 99% confidence level. What is the maximum likely loss on the position for the next 3 weeks, assuming that there are 16 working days in 3 weeks? Such questions they can come. See, your open, you know what is open position? Forex open position. Must be knowing, no? There are 2 types of open position. It can be long or short, overbought, oversold. Here, the Forex open position of your bank on a particular day is 10 crore. There is an overnight open position, and the VAR for overnight position is 10 crore. So the VAR is 10 crore. And what is the maximum likely loss on a position for the next 3 weeks? That's a question. So you are given the overnight VAR. You want a longer period VAR. Longer period VAR means you want 3 weeks VAR. So 3 weeks VAR, how do you calculate? 3 weeks VAR is equal to overnight VAR into square root of n. So overnight VAR is 10 crore into root of 16. How do you take? Because 3 weeks is 21 days, but it is given that there are only 16 working days. Therefore, root of 16, that comes to 10 into 4, rupees 40 crore. Is it clear? I'll repeat once again. It is given that the war is 10 crore. Overnight war is 10 crore. We wanted 3 weeks war. What is 3 weeks war? So 3 weeks war, you calculate overnight war in the square root of 3 weeks. Here 3 weeks, you need not take 21, you have to take 16 because it is given that the number of working days is 16. So it is 10 into 4, that is 40 crore. Look at another one. The volatility per annum is 25%. And the number of trading days per annum is 256. What is the daily volatility? This is the other way. You have given a longer period volatility, you have to calculate a overnight volatility or daily volatility. How do you calculate? Longer period volatility is overnight into square root, or overnight volatility is equal to longer period volatility divided by square root of it. So here, per annum is 25%. So per annum volatility is 25%. And number of trading days is 256. So overnight, how do you calculate? Overnight volatility is equal to 25 divided by root of 256. That means 25 divided by 16, 1.56. Yes.
Sir, here 25% means it will come 0.25.
25% it is given. 0.25, you can take 0.25 also. Then you have to multiply with 100. That's all. Both way you can do. 25 by 16. If you take it is 0.25, you can multiply. You have to multiply with 100. That's all. You calculate 25 by 16, 1.56%. Is it clear? We'll move on to an important topic, that is bond.
Sir, one second. Repeat.
This one. Here what is given? They have given you per annum volatility. They want overnight volatility. So per annum volatility is 25%, or you can take it as 0.25. And it is asked to calculate daily volatility or overnight volatility. So for that, you have to divide with the square root of 256. So 25 by 256, 25 by 16, 1.56. Or if you are doing it 0.25 by root of 256, you multiply with 100. You will get the same answer, 1.56.
Okay, sir. Okay. Thank you, sir.
Now we'll move on to bond. This is an area, even though you have studied it in your JAB, students get always confused with this bond. It's a very simple concept, and there are some important theorems. So these are all the important terminologies which we come across in bond. What is bond? It's a debt instrument. This can be raised by either government or by a private firm. Both public and private, they can go. Next, what is coupon? This is nothing but interest on this bond. Face value or par value, the issue price. Maturity period, what is the period of this particular security? Redemption value, what is the value they get on maturity? Market value, at what rate this is traded in the market. And YTM, yield to maturity. See, an yield an investor gets, the average yield which an investor gets if a person holds this particular bond till its maturity. That is YTM. And here, YTM is calculated by discounting the future cash flow, including the redemption value. Remember YTM, or how do you calculate YTM? You have to take into account all the cash flow. I'll explain in bond mechanism how it works. So all the cash flow, the coupon payment and the maturity value, entire thing you discount and you can arrive at a particular percentage, and that is called the YTM. And then duration. What is duration? Duration is for break even of the bond. That means up to what time a person can hold a security, and after that they have to dispose it off, so that this particular holder or this investor is not affected by the interest rate risk. That is duration. So it is nothing but the holding period for break even. That means there is a situation where there is no profit, no loss to an investor, and that level of holding period is called the duration. It's a little bit difficult to understand, but if you read it, the topic very leisurely, and now there is no time. Now you just understand the formula because you can go beyond that. We will solve some problem here. Next is modified duration. What is modified duration? This is a measure of price sensitivity. Means how the value of the bond is fluctuating, or its volatility, how it is varying with respect to change in interest rate. Suppose there is a change of 1% interest rate. What happened to the value of this particular bond? How much it is volatile? That ratio or that percentage is called modified duration. So duration is always represented in years, and the modified duration is in percentage or a number. It can be a ratio. Then zero coupon bond. What is meant by zero coupon bond? Zero coupon bond is a bond where there is no coupon payment. So in the case of a zero coupon bond, what is its duration? Its duration is its leftover maturity period. That means a bond is issued in 2010, maturing in 2025. So now it is 22. So the leftover period is, which is 3 years. What is its duration? 3 years. So duration of a zero coupon bond is its leftover maturity period. Now, these are all this slide is very important as far as you are concerned, because I have given some theorems and some formulas. So these formulas will help you to solve the question, whether it is multiple choice or whatever it may be. See, very important statements I have given, or the theorems. Bond, price of a bond and yield are inversely proportional. What is its meaning? They move in opposite direction. If interest rate moves up, so here, see, how do you differentiate interest rate and coupon rate? They are different. Suppose a bank, let me share the. See, bond will work like this. Say the face value is 100 rupees and the coupon rate is 5%. And the number of years is 5 years. So what is the meaning of this? Or a person who is investing in this bond, what are the cash flows or what are the return he is getting? So at the end of first year, he gets a coupon payment, or what is coupon? An interest. At what rate? 5% on 100 rupees. So what is the 5% on 100 rupees? This is 5 rupees. Then second year, 5 rupees. Third year, 5 rupees. Fourth year, 5 rupees. And the fifth year, he gets the coupon 5 rupees plus the invested amount 100, means 105. So these are all generally we use the term cash flows. There can be a situation, this redemption value either will be at par, or it can be at a discount, or it can be at a premium. That at the time of issuance of this bond, the company will mention this bond is redeemed on maturity. Redemption means maturity. On maturity, this will be redeemed at a premium of 10%. That means this 100 plus the company will pay 10% of it as premium also. Similarly, the bond is redeemable at a discount of 5%, means instead of 100, the company will pay only 95 at the end. So that possibility also comes. If nothing is mentioned, you can presume that on redemption, the company pay the face value. Fine. So these are all the benefit they are getting. So how do you calculate? Now this 5% is the coupon rate. Now the yield which he is getting is something different, because suppose this bond, the face value is 100. After say 2 years, this investor wanted to sell it in the market. In the market, it may be, he may be selling either at 95 or he may be selling at 110. If he is selling at 95, a person who is buying this bond gets more than 5%, isn't it? His yield is more than the coupon rate, because he need to invest only 95. At the end of every year, he get 5% on 100 rupees. So which in percentage, if you calculate on 95, it will be more than 5%. So that is a concept. So coupon rate and yield are something different. If the market value and face value are equal, the face value is 100 market value is also 100, then the coupon rate and YTM are both the same. If the market value is 90, the yield will be more than the coupon rate. And if it is 110, the yield will be less than the coupon rate. That is the principle. Yield and value moves in opposite direction. So yield means the market industry or the required industry. So you look at the market rate with the coupon rate, which is more. If market rate is more, what happened to the value of the bond? It will be less than its face value. That is the concept. So that theorem is very important. You have to learn that theorem. And the next one is, suppose a bond is, this is the current year. This is, say, year 1, year 2, year 3. Let me draw it correctly. Year 1, year 2. A bond is maturing after 3 years. This is the face value. And say the face value is 100. There can be a situation, this may be traded at 110, or it can be at 95. If it is traded at 95 means this is traded at a discount. That means as time passes and it approaches the maturity. So this moves, the graph moves like this. So this converges as it approaches maturity. This value of this bond converges to its face value. Similarly, suppose it is issued at a premium. This premium will decrease as it approaches maturity. So this graph, if you remember this graph, this concept will be very clear. So this is the face value. Face value is 100. If a bond is traded at a discount, as it approaches maturity, the discount reduces and the value of the bond converges to the face value. Similarly, if a bond is discounted at a premium, as time passes, the value decreases, or the premium decreases, or the value decreases at it reaches at the face value on maturity, because nobody will buy on maturity a 100 rupees face value bond with 110, because he gets only 100 rupees, isn't it? So this graph make it very clear. This also 2 theorems which I have given there. Let me share it. So here I have given, if a bond is traded at a discount and the discount declines as it approaches maturity. If the bond is traded at a premium, the premium on the bond declines as maturity approaches. Next, some other theorems are, longer the duration, greater is the price sensitivity. Make it very clear. If the duration is more, its price sensitivity is also more, or they are directly proportional. Then duration and YTM are inversely proportional. If one is more, the other will be less. So in the multiple choice question, you can expect such questions, not the theorem straight away. They will give 3-4 bonds, which is having least duration or which is having highest duration. How do you calculate? You look at the various bond, they are YTM. Which is having lowest YTM will have highest duration, or which is having highest YTM will have least duration. So those application of theorems will be there in the question. Then coupon rate and volatility are inversely proportional. Volatility or price change and coupon rate are inversely. So higher coupon rate, price volatility will be less. For less coupon rate, the price volatility will be more. Then larger the coupon rate, smaller its duration. If coupon rate is more, duration is less. Then larger the maturity, longer the duration. If the maturity is more, there are 4 bonds, one 10-year, another 5-year, another 3-year, another 2-year, which have the largest duration, which is having the largest maturity. The 10-year bond will have largest duration. Like that, these theorems, you have to understand the concepts. Now I will give that. Pardon?
Sir, actually here the bond and the duration and YTM, sir, in three aspects means how can we confirm, sir? Duration and bond, YTM is inversely proportional, and the bond and duration is directly proportional. If the duration is means I'm having some confusion about it.
No, duration and YTM. What is duration and YTM? Duration and YTM are inversely proportional. Then duration and period, they are directly proportional. Coupon rate and duration, inversely proportional. One and the same thing. See, coupon rate and YTM more or less the same concept, no? Yield. So they are inversely proportional. Coupon rate and YTM, inversely proportional. YTM and duration inversely proportional. And then coupon rate and duration, they are also inversely proportional. Then period and duration, directly proportional. These are all the theorems which you should learn by heart. You have to apply this in the question. I may not be able to tell how they will ask. If you know the theorems or if you know the concepts, you can answer the question. Now look at the formulas. Number one, how do you calculate the duration? It is sigma PV into T by sigma PV. Very simple formula. Sigma, we'll do a question. Sigma PV into T by sigma P. What is sigma? Sum. Present value into time divided by sum of the present value. That is duration. Modified duration, again, very simple formula. Duration divided by 1 plus y by n. And percentage change in value of a bond is minus modified duration into percentage change in yield. These are all the important formulas which you have to by heart for the purpose of the examination. One is how do you calculate duration? How do you find out modified duration? How do you find out the percentage change in the value of a bond? We'll do on each or more. I'll sort. Now look at a question. This is, I'm not going to do it in the board because it takes a lot of time. A bond of face value 1000 is having a coupon rate of 10%. It has the period of the bond is 3 years. You have to calculate three things. Number one, what is its value? Valuation of the bond. Probably there can be a question on that also. And in CAIIB, I don't think such question they will ask because this is fundamental. They used to ask in JAIIB. But you should know the procedure. What is the present value or what is the market value of a bond? How do you calculate? To calculate the market value of a bond, always a reference rate is required. They will give what is the value of the bond at an asking rate or at required rate. So here the coupon rate is 10% and the required rate is 12%. So what you have to do, you have to discount the cash flows at 12%. Means here the time value of money is taken into account. You must be knowing how do you calculate the present value. If the future value is given, how do you calculate the present value? How do you calculate that is fundamental basics.
Future value divided by 1 plus R whole.
Yes, yes. Here, see, you have learned this formula. Compound interest, there is a formula. A is equal to P into 1 plus R the whole raised to. Here, I am putting, this is the cumulative amount, means the amount which you are getting after certain period. Or I'll put this as the future value. This is equal to P, the amount you are investing now. I can name it as PV into 1 plus R the whole raised to. Or from this, present value is equal to future value by 1 plus R the whole raised to. So this formula we make use of in bond very often. So this you have to be very thorough. So what is the present value concept? Suppose you are getting 100 rupees after 1 year. What is its present value? At a percentage, at 12%. How do you calculate? You are getting 100 rupees after 1 year. What is its present value? Its present value can be found out by future value by 1.12 raised to 1. Suppose you want to calculate the value of 100 rupees. You are getting after 2 years. How do you calculate? 100 by 1.12 square. This is the formula. This is the formula which you have to make use of for calculation of the value of a bond, present value of a bond. So this is made use of here. Look at the question. The face value is 1,000 rupees. Coupon rate is 10%. So the cash flow I given first year 100, second year 100, third year 1,100. Now you are asked to calculate the value of the bond at 12%. So you have to discount the future cash flows at 12%. How do you calculate? How do you discount? That means you are getting 100 rupees after 1 year. What is its discounted value at 12% today? That means what is the present value of 100 rupees at 12%? You have to calculate 100 by 1.12, 89.29. Then second 100 rupees you are getting after 2 years. So that means its present value is 100 by 1.12 square. Third 1,100 divided by 1.12 cube. You calculate it, add it, you will get 951.98. So the value of the bond at 12% return or at discount 12% is 951.98. Clear? Second question is, what is the YTM if this is traded at 980? So a market value is given. This particular bond is traded in the market, so it is available for purchase at 980. What is its YTM? There is again a simple formula. It is coupon amount plus redemption value minus market value divided by remaining number of years. The whole divided by redemption value plus market value divided by 2 into 100. So here the coupon amount is 100 rupees. The redemption value is 1,000 rupees. Market value is 980 and number of years is 3. You substitute, you get it as 10.77. So the coupon rate is 10%, but YTM is 10.77. Why it is more? Because this is traded in the market at a lesser price. 1,000 rupees bond is available for purchase at 980. That is the reason, because a person who is paying 980, he gets a bond and he gets 10% on 1,000 rupees. Because the company, remember, the company pays off the dividend or the coupon on the face value, not on the market value. Make it very clear.
Sir, how do you get this 100 in cash flow, sir? 100, 1,100.
100 is coupon amount. You look at the formula, coupon amount. Coupon amount is 100 rupees because face value is 1,000, coupon rate is 10%. What is the coupon amount? 10% on 1,000 rupees. It is 100. Then redemption value means the amount of which the company pays off on maturity. It is 1,000 rupees. If nothing is mentioned, you can presume that the redemption value is the face value. Otherwise, they will give in the question, this is redeemed at a discount or at a premium. If nothing is mentioned, it is redeemed at par. So the redemption value is 1,000. Next is the market value. It is given in the question. Market, this is traded in the market at 980. So the market value is 980. Remember, a security or a bond or a treasury bill will be traded in the market sometimes at a premium or sometimes at a discount. If it is at a premium, means the market value will be more than the face value. If it is traded at discount, that means it is sold in the market at a lesser price than the face value. Okay. Next is duration. Duration, look at the formula. What is the formula? Sigma PV into T. How do you take PV into T? We have PV now. PV is 89.29, 79.72, and 782.97. How do you get PV into T? You multiply with T. What is T? The time, the year, 1, 2, 3. So the first year, T is 1. So 1 into 89.29, it is 89.29. Second year, it is T is 2. 2 into 79.72, 159.44. Third year, T is 3. There, the present value is 72.97. Multiply with 3, you get 2348.97. You add it up. That is sigma PV into T. Then you divide the third column, the last column, with the next column. That means 2597.64 divided by 951.98 gives you the duration as 2.73 years. That means if a person who is buying this bond, he hold it for 2.7, almost 2 and 3/4 year of a year, and then sell it off, he gets the expected return. That is the meaning of duration.
Sir, in case of a semi-annual bond, how do we take that T? It is 1, 2, 3, 4 or 0.5, 1.5 like that?
It is 0.1. It is 0.5. 0.5. I think I have given another example. Let me check. Yes, this will be useful for you. Here, the face value is 1,000. Coupon rate is 6%. Half yearly payment or semi-annually. Semi-annually means the coupon also comes down, isn't it? 6%, 1,000 rupees per year, it is 60. So per half year, it is 30. So here the value of T will be 0.5, 1, 1.5, 2, 2.5, and 3. Appropriately, you calculate. So here again, remember, at 10% discount, you have to take the denominator as half, not 10, 10 by 2. Got it? If it is annually, the denominator will be 1.1. Here it is semi-annually or half-yearly. That means, again, the rate has to be divided with 2. So 10%, present value at 10% means if it is half-yearly, denominator will be 1.05. Calculate, multiply, and you will get the duration.
This market value question was asked this time ABM, sir. Exactly the same value, sir. 3 years bond with face value.
Asked in the question.
Yes, sir, this time.
It's a very simple thing. See, very simple thing, no? I think it's clear, no?
Yes, sir. Yes,
How do you calculate? See, you forget
Sir,
about the
current yield also will be get a half, sir. Say half yearly means.
Right, also you have to divide with 2. That's what. Yes, yes. Because it is half yearly, you know.
Yes,
what
sir.
What is the first question is what is the value of the bond? Second question is what is the duration of the bond at 10%? And third is what is the modified duration? These are the 3 questions. Now, see, you have to calculate or you have to discount the future cash flows at 10%. But remember, the cash flows are not annually, it is half yearly. So this is the fundamental you should remember. Whenever the periodicity is half yearly, you have to multiply the number of years with 2. If it is 3 year, N will be 6. And if the rate is 6%, R will be 6 by 2, 3%. That's what you look at for 1,000 rupees at 6%, the coupon amount is 60 rupees. But if they are paying it half yearly, every half year they pay 30 each. So you have to calculate accordingly. So 30,000 you are getting after 6 months. So what is its present value? So it is 30 by 1.05 raised to 1. Next 30 by 1.05 raised to 2. Like that you calculate.
Present value and the market value is same.
Present value and market value. Yes, same thing. Present value and market value same.
Sir, this duration and Macaulay duration is one and same?
Duration and Macaulay duration one and the same thing. Modified duration is different. So duration is also known as Macaulay duration because the scientist, the economist Macaulay only found out the concept of duration. So this is also known as Macaulay duration. But modified duration is different. Modified duration is the rate of change with respect to change in interest rate. That is modified duration. The price volatility with respect to change in interest rate. That is modified duration. So duration is in years, whereas modified duration is a number, or you can say a ratio, or it's a percentage like that. So here the third question is what is the modified duration? So how do you calculate modified duration? Duration by 1 plus y by n. Here what is n? N, if it is annually coupon payment, n is 1. If it is half yearly coupon payment, N is 2. If it is quarterly coupon payment, N is 4. Okay. Generally, either the bond will be annually coupon or half yearly coupon. If it is half yearly coupon, in the formula you can take N as 2. Therefore, here duration is 2.776 and N is 2 and yield is 10%. So 2.7761 by 1.05, you got it as 2.6439. Any doubt?
So this would be like a 2 mark or 1 mark, sir, because for 1 mark we have to waste around 5 minutes, sir, in the exam for calculating this, sir.
No, but
sir,
the thing is, it will be questions, some 3 marks or 5 marks, a case will be given. You have to ask what is the present value, what is the duration, what is the modified duration. Then the same working will help you to find out the modified duration or the duration also, isn't it? The same table you write, multiply. But suppose,
all the formulas are interlinked. So if we find only, we can go to the next.
Yes,
then only we can find the next. So
exactly.
From the beginning, we have to start working from
Exactly. There is no shortcut method. You have to, that's what, see in the question, see, Validans are used to all faculties used to tell, see, there are 100 questions. Out of 100, some 50 questions you can answer without any calculation. Just read, answer it. Means in 30 seconds you can answer. So like that you score the 50 questions. The leftover, wherever the calculation is needed, you do it in the after that. That is the way.
Sir, what is Y?
Yield, or the interest rate.
10%, sir.
10%. Here it is 10%.
10 by 2 means 5 only will come now, sir.
5%.
Half yearly.
Yield is always in percentage. So 5%, how do you write? 5 by 100, 0.05.
Sir, PB means the total earnings if we keep the bond till maturity. Am I right, sir?
YTM. You are.
Yeah, but my question is that one. Then by calculating that PV, the rate what we are using, is it the YTM?
No. See, what is YTM? YTM is the rate. Here you are calculating the value. See, here a person wanted to invest in this particular bond. Fine. So he says, I need a return of 10%. I want a return of 10%. So at what price I can buy this bond? For that he calculates, and if he gets this bond at 898.52, even though the coupon rate is 6%, he gets a return of 10% because he gets the bond at a reduced price. Got it?
Sir, here N is 1.
Pardon? N. Annual. If it is annual, here N is not 1. Here N is 2 because rate is 10%. You are asked to calculate the modified duration when the yield is 10%. Yield is 10%.
Here N is 1 because it is calculating half yearly.
0.01 by 2, madam.
Half yearly means N is 2.
Half yearly means divided by 2.
Divided by 2. See, I told you, if the coupon payment is annual, N is 1. If the coupon payment is semi-annual, N is 2. If the coupon payment is quarterly, N is 4. Am I clear? Here it is given the coupon payment is
here
half
it is
yearly.
here it is y 1 plus y by 2.
1 plus 10 by 2.
1 plus y by 2 means it is not 1 plus y 6. It is not like that. Y is yield, and yield is always in percentage. So here y is 10%. So 10% by 2 is 5%, and 5% is 0.05. You want me to do in the board? It's a very simple.
No.
Go ahead.
Okay, let's move on to the next one because the time is going fast. It's 5 o'clock.
Sir, is there any relevance to coupon percentage? That's 6%.
Pardon?
Any relevance to coupon percentage? That 6% is not using in.
It is used here, no? It is used. Otherwise, how do you get the cash flow?
Calculating cash flow.
Okay. Find the modified duration of a bond with duration 2.5 and a YTM 6%. Simple question, straight question. How do you use the formula? You want me to do in the board? I will do it in the board.
No, sir. No, sir.
Okay. So apply the formula. Duration is given 2.5 and YTM is 6%. So 6%, if nothing is mentioned, it is annual. So 6% means 6 by 100, 0.06. So 1 plus y by n is 1.06. So you will get the answer 2.36.
YTM is market rate, no?
It is given. YTM is not market rate. YTM is yield to maturity. It is what is the yield a person gets if he hold it till its maturity. Yield is what he is getting now. Yield to maturity and yield is different. See, current yield.
Market rate of interest. YTM is rate of interest, right now?
YTM, you cannot say it is rate of interest. What is YTM? I have given the definition. It is the discounted value of the future cash flows. At what rate the future cash flows will come. So that rate we call YTM. See, suppose 1,000 rupees, a person is investing 1,000 rupees. At what discount rate this will come? So that percentage is called YTM. So yield to maturity. If a person is buying a bond 1,000 rupees bond is buying at 900. He is holding it till its maturity. He is getting the frequent coupon payment, and all the coupon payment is reinvesting at a certain rate, at the expected rate. And what is the yield he is getting? That is called the YT, yield till maturity. And current yield is something different, or current yield and YTM is different. A person can buy a bond today and its maturity is 10 years. He disposes it after 1 year. So its yield is something different. Its yield and the YTM may be different. Okay. A bond with remaining maturity of 4 years and present yield of 8% has modified duration 3.5. What is its Macaulay duration? It's a very simple question, these questions. You have given the modified duration. You have to calculate the duration. The previous question, modified duration has to be found out given the duration. The same formula with a cross multiplication. You want me to do in the board, because the explanation will not give much benefit.
No, sir. Not required.
Not required.
Sir, not required, sir. Not required, sir.
Not required, sir.
The next question, sir.
See, this formula, see, modified duration is equal to duration by 1 plus y, or y by n. Here, remember, this 1 plus y means y by n is together. That's more important. So here, from this, how do you get duration? You cross multiply. Duration is equal to modified duration into 1 plus y by n. This is the formula. Okay. This formula we'll use for. So if you learn this formula, modified duration formula, from that you can derive the formula for duration. Every time if I go for the whiteboard, it takes a lot of time. That's what I avoid. So here there are two situations. Two questions are there. If the coupon is payable annually, what is the modified? What is the Macaulay duration? Number two, if the payment is semi-annually, what is the duration? So first case, coupon payment annually. How do you calculate duration? Duration is equal to modified duration into 1 plus y by n. Modified duration is given 3.5. 3.5 into 1 plus y. Y is yield, it is given as 8%. So 1 plus 8%, 1.08. You'll get it as 3.78. Second, coupon payment semi-annually. So in that case, if it is y by n becomes 2. So 3.5 into 1.04. You'll get just 3.64 years. Next question, a bond of face value 100.
In this question, a remaining maturity value 4 years it is given. What is the relevance of that?
A bond with remaining maturity, because here that remaining maturity they are given, there is no relevance in this particular question, but to get you confused, that's all. A bond with remaining maturity of 4 years and present yield 8% has modified duration 3.5. It is not required. It's not required. Even otherwise also you can attend this question. But always remember the duration will be always less than the remaining maturity. Got it? And only for zero coupon bond, it will be equal to the remaining maturity, the duration.
Okay, sir.
Okay.
Thank you.
Question 5. A bond of face value 100 carrying a coupon rate of 12% is traded in the market at 90. What is the current yield? How do you calculate the current yield? Again, there is a formula for current yield. This formula you need not learn by heart, because it is a very simple concept. A person who buys a bond at 90, he gets a coupon of 12% on 100 rupees. So a person invests 90, he gets 12 rupees. So how much he gets for 100 rupees? This is the formula. So 12 into 100 by 90, he gets 13.33%. So current yield, the formula is coupon amount into 100 by market price. If you are not very familiar with the percentage, you learn by heart the formula. Current yield is equal. How do you calculate current yield? Current yield is equal to, or present yield is equal to, coupon amount into 100 by market price. Here market price is 90. Coupon amount is 12% on 100. That means 12 rupees. So 12 into 100 by 90. You will get 13.33%. Fine. Next question. The current price of a bond of 100 rupees is 98.50 and its duration is 2.7613. If the yield is likely to change from 6% to 5.8, find the percentage change in the value of the bond. Also find the revised price of the bond. So a similar question also can come. The face value is 100. That is now traded at 98.50. That means now its value, the present value of the bond is 98.5. Its duration is given 2.76 on 3 years. The yield is likely to change from 6 to 5.8. That means now the yield is 6% or the current yield is 6%. It may change to 5.8. If it changes to 5.8, what is the percentage change in the price of the bond and what is the revised price? Two questions. Here you have to make use of a formula I have given you in the beginning. To find out the percentage change in the value of a bond, the formula is minus modified duration into percentage change in yield. Minus modified duration into percentage change in yield. I'll just minimize this. Please, some of you, please, okay. You have to off your video because it gets distracted. Okay, you want me to do in the board or this is enough?
No, so please do on board.
This is enough.
Enough, okay. So here, what are the things given? You have given the duration. You want the percentage change in the price. For calculating the percentage change in the price, we want modified duration. Apply the formula. Modified duration is equal to duration by 1 plus y by n. What is duration? 2.7613. So 2.7613 divided by 1 plus yield. Here nothing is mentioned. That means it is annually payment, annual coupon. So the yield is 6%. That means 6% means 6 by 100, 0.06. So 2.7613 by 1.06 give you the answer as 2.605. So the modified duration is 2.605. Straight away apply the formula. What's the formula? Minus modified duration. Put a minus sign. Minus 2.605 into percentage change in yield. Yield is changing from 6 to 5.8. So yield changes from 6 to 5.8 means yield is reducing from 6 to 5.8. How much it is reduction? 0.2%. Since it is a reduction, you have to indicate with the minus sign. Suppose yield is changing from 6 to 6.5. What is the change in yield? 6 to 6.5 plus 0.5.
Plus 0.5.
Plus 0.5. Yes, exactly. So here it is minus 0.2 because it is a reduction. So minus modified duration into minus 0.2. Minus into minus gives you plus 0.521%. So the first answer is the percentage change in the value is 0.521%. And here this plus indicates what? Value will go up. Value will go up. Value will increase. So what is the revised price? How do you calculate the revised price? Current price is 98.50. How do you calculate the revised price? The price
Adding up that term.
0.521% of 98.5. So 98.5 plus 0.521% of 98.5. How do you calculate it? 98.5 into 0.521 by 100. Add it. That you will get you 51 paise. So the revised price is 99.01. Am I clear?
Sir, you said that the modified duration should have a minus sign also.
No.
A change in the price of a bond. In what all cases should it have a minus sign?
No. What I told you, for the formula, modified duration is always a number. It has no sign. It is always positive. It is representing a digit or a percentage. Now to calculate, to calculate the percentage change, it is the formula is put a minus sign, write modified duration into change in percentage change in. That is the formula. So modified duration is not negative always. In the formula, to find out the percentage change, you put modified duration with a minus sign. That's what modified duration is 2.605. In the formula, it is minus 2.605. into
In
minus.
the it is always minus modified duration into percentage change in yield.
Exactly. Formula is always minus modified duration into percentage change. And if the percentage change, if it is increased, the resultant will come minus percentage, so much percentage, isn't it?
Yes, sir. I understand.
That means what? Minus so much percentage is a change in price means
reduction.
that much percentage value will come down. Value will decrease. Exactly. So here the revised price is 99.0. Got it?
Yes, sir. Thank you, sir.
Current yield of a government security of face value 100 is 8%. If the market price of the security is 120, what is the coupon rate? Current yield of a government security is 100 rupees and current yield is 8%. If the market price of the security is 120, what is the coupon rate? Again, you have to use the same formula. Current yield is coupon amount into 100 by market price. Same formula you apply here. From this, what is the coupon amount? Coupon amount is equal to current yield into market price by 100. So 8 into 120 by 100 will get 9.6 as the coupon amount. So for 100 rupees, 9.6 coupon means percentage is 9.60%. Simple formula. You need less than a minute for the answer, isn't it? Look at this. The price of an 8% bond with face value 100 depreciated to 99.80. What is the current yield and how much basis point is the yield changed? The value of a bond, face value is 100. Its a coupon rate is 8%. This is depreciated to 99.8. What is the current yield? So how do you get the current yield? Current yield is equal to, apply the formula, coupon amount into 100 by market price. That means coupon amount is 8 into 100 by market price is 99.8. So you'll got the current yield as 8.016. What is the change in yield? 8% to 8.016%. That means there is an increase in 0.016 percentage. You have to convert this into basis point. For that, you have to multiply with 100. If you multiply this with 100, you will get it as 1.6 basis point. Clear?
Yes, sir.
Is it clear?
Yes, sir. Yes, sir.
Yes, sir.
The bond of an organization, the bond portfolio in an organization consists of AAA bond, AA bond, and a single A bond. Rated. This is a rating. AA, AAA, AA, and A rated bond. The price of the bonds are 3 lakh to 5 lakh. The duration. What is the duration of the portfolio? Average duration of the portfolio. You have to calculate the weighted average. So how do you calculate the weighted average? You have to attach the weight for each. So the total investment in bond portfolio is 3 plus 2 plus 5, total 10 lakh. So out of 10 lakh, AAA rated is 3 lakh. And its duration is 4. So 4 into 3 by 10 plus 5 into 2 by 10 plus 6 into 5 by 10. We'll get the average duration as 5.2. Simple mathematics.
Why, sir, 10?
Because see, the total investment is 3 lakh plus 2 lakh plus 5 lakh. That is, how do you calculate the weighted average? So total investment 3 plus 2 plus 5, that is 10. Out of 10, 3 lakh is AAA rated. And the duration of AAA rated is 4. So 3 by 10 into 4. And the 2 lakh is AA rated. And that duration is 5. So 2 by 10 into 5 plus 5 by 10 into 6. Okay, 5.2. Weighted average, that's all. And government security, 11% government security.
4 into what?
Previous
slide.
4, 5, 6 were?
Duration.
Duration.
Duration respectively. See, for organization is holding 3 companies bond. One bond is AAA rated and its duration is 4. And the value of the bond is 3 lakh. Another, they are holding AA rated bond. Its value is 2 lakh. Its duration is 5. And the third, A rated bond. And the value is 5 lakh. Its duration is 6. What is the portfolio duration? That's a question. 11% government security with face value 100 is quoted at 110 currently. Look, so the current market price of 100 rupee security is 110. If the market interest rate goes down by 1%, what is the market price of the security? I'll repeat once again. This particular security is giving a return of 11%. Face value is 100, but this is traded in the market now at 110. So can you tell me what is the current yield? Is it 11% or something else? 100 rupees bond is sold at 110. So the current yield will be less than 11%. It is 10% only. Now this yield is reduced by 1%. That means yield is reducing from 10 to 9. So what is the market price? Coupon amount into 100 by current yield. 11 into 100 by 9 is 122.22. Is it clear? But probably most of the students, what they will do, they will look at the question. 11%. It is reduced by 1%. So the current yield is, they will take it as 10%. Isn't it? It is not the question. The question is, now the government is giving 11% as a coupon, but this is traded now at 110. Face value 100, traded at 110. So remember the theorem. When the value is more than the face value, yield will be less than the coupon amount. So definitely 11% coupon will yield a lesser amount. So yield will be, or the market rate might be less than 11. So you calculate it, you got it as 10. So from 10, it goes by 1%, goes down by 1%. So the revised percentage is 9%. So the current yield becomes 9%. What is the market price? 11 into 100 by 9. Remember, the coupon amount remains the same because coupon, who is paying? Coupon is being paid by the company or by the government which issue this particular security. Then they have, at the time of issuance, they said it is 11%. So irrespective of at what rate this is traded in the market, the bond issuing firm or government has to pay the coupon rate. Even though it is traded at 110 or at 120, the coupon amount remains the same. That's it. We have taken it as 11 rupees. A bond has a modified duration of 3.5. Find the percentage change in the price of the bond with 50 basis point increase in yield. Simple question. What is the percentage change in the price of the bond with 50 basis point increase? So what is modified duration? Straight away given. Modified duration 3.5. Use the formula. Minus modified duration into percentage change in yield. So modified duration 3.5. Minus modified duration minus 3.5. And percentage change is 50 basis point. 50 basis point conversion to percentage, it is 0.5. So minus 3.5 into 0.5. It is increase. So plus 0.5. And plus into minus, minus 1.75. The price of the bond will decrease by 1.75%. Am I clear?
Yes, sir. Yes, sir.
Yes, sir. Now we'll move on to option. With this, we'll wind up bond, move on to option. Very confusing to at least some of you, but it's again a very simple concept. You're all familiar with forwards. Am I right? What is forward? Forward means it's an agreement between a bank and a customer. They enter into an agreement for putting through a future transaction. So they enter into a forward contract. And the forward contract can be two types. One is a forward purchase contract or a forward sale contract. In a forward purchase contract, the customer and the banker enter into a contract where the customer says, what the customer says, in a forward purchase contract, let me clear this. See, there are two types of forward contract. One is a forward purchase contract. Another is a forward sale contract. This who makes with a banker? A banker and an exporter. And forward sale contract, a bank and an importer. So here in forward purchase contract, the customer and the bank enter into an agreement for putting through a transaction on a future date, representing an amount and a rate. So suppose it is US dollar, 1 lakh, and the rate is say 74 rupees. They enter into a contract, and this is maturing on a date, say on 30th of March. That means today they are entering into a contract, and today the bank will look at the prevailing rate, and they look at the trend, they look at the forward period, the interest rate differential, everything, and the banker quote the rate, and the rate is 74 rupees. That means on 30th March, when this contract is matured, the banker, the customer, the exporter will tender the document or submit the document to the bank worth 1 lakh, and the bank will buy that at 74 rupees, irrespective of what is the rate prevailing on 30th March. So here, the exchange rate fluctuation is insulated by this contract. That means the exporter is not worried how the value of dollar changes. He is not affected by the value of the currency or by the exchange risk. So this is a sort of insulation for the exporter or for the customer. And at the same time, bank is also not going to lose anything, because bank might have done on the same day when they execute this contract, they have entered into an opposite contract. A forward purchase, they have entered into a forward sale contract, but that must be something more. The sale contract may be 74 rupees 50 paise, and the banker get 50 paise as their profit margin. Got it? So irrespective of the ruling rate on 30th March, this is a commitment given by the bank and the customer, and none of them can back out. So it is binding on the customer as well as the bank to execute the contract. That is a forward contract. Similarly, a forward sale contract, banker and an importer, they are entering into a contract where the importer says, I will buy from you, or the bank will say, I will sell you certain amount at certain rate on such and such date. Fine. So here, this contract also, both the parties, it is binding. None of them can back out. If the bank is an institution, there is no question of backing out. The customer may back out. That means sometimes, due to some eventuality, the exporter or the importer may not be able to do the export or import. Then in that case, the customer comes to you for cancellation, and you will cancel as a banker, you will cancel it, and any loss incurred by the bank will be recovered from the customer, and any profit you will pass on to the customer. We have done exercise also. So I think that part is clear. So remember, in the case of a forward, it is binding on both the parties, banker and the customer. Banker is he is making the contract, and he is selling the contract, and the customer is buying the contract. It can be a purchase or sale, whatever it may be. Now coming to option, what is the basic difference between this forward and option? In the case of option, the word itself, look at the word. What is the word? The word, it is option. What is the meaning of option? And the question, you are given 4 options. You have to choose anyone, isn't it? Similarly, the option is given to the customer. Here there are, similarly in the case of forward contract, there are 2 parties. One is a bank, another is a customer. Here also, there is a bank and there is a customer. The bank is always the option seller, and the customer is the option holder. Now, the option can be 2 types. One is call option. Next is put option. Call option means right to buy, and put option means right to sell. Who has got the right? The right is to the customer. This is the important point. So here, in the case of an option contract, the customer has got a right to either to buy or to sell, depending upon which type of option it is. Fine. And here, the difference between forward and option is the customer has got an option. If he wanted to exercise the option, he will do it. If he doesn't want it, he will not exercise the option. So when do a customer exercise the option? If it is favorable to him, he will exercise. If it is not favorable to him, he will not exercise. Make it, is it clear? Therefore, the exercising an option contract is option to the customer. Customer can back out. If the customer is not coming forward to execute an option contract, the banker has got no right to proceed against him to recover the loss, if any. Make it very clear. So the risk for the option seller or for the banker is enormous. And the risk for the option buyer, means the option holder, is minimum. Am I clear?
Sir, here always one party will be bank.
Always one party will be bank. Even some options, they are traded in the futures also, in the futures exchange. But generally, mostly, and see, there are 4 types of derivatives you might have studied. One is forwards, another is options, third is swaps, and fourth is futures. And all the 3, the first one, forwards, options, and swaps, are OTC derivative. That means it can be obtained from a bank across the counter. Whereas futures, they can avail it from the exchange, futures exchange only. So futures is an exchange traded derivative, and all the 3 are OTC derivative. Therefore, mostly option contract, one party will be bank, another party will be a customer.
Okay, thank
you. Okay. So this concept, if it is clear, I will proceed further. It's the difference between these two. Now, there are 3 types of option. One is ATM, another is ITM, another is OTM. So here, this concept you have to be very, very clear, because what is ATM? At the money option. What is ITM? In the money option. And what is OTM? Out of money option. So an option is ITM. If he executes, he gets a profit. Or if it is favorable to the customer, we say that it is ITM. If it is, that means here you can say either there is a positive cash flow or there is a profit. Here, if we execute, there is a negative cash flow, or if we execute, he incur a loss. So you ask universe, whenever a customer, if you do something, if he incur a loss, he will not do it. Therefore, in the case of OTM, if an option is OTM, he will not exercise the option because it will be loss. Similarly, what is ATM? ATM means there is 0 cash flow. That means neither profit nor loss. So no profit, no loss. So similar, this ATM also, generally a customer will not execute because there is no point in executing. He is neither gaining nor he is losing. So this is the first concept. Now I will explain it. We have to look into 2. One is a call option. What is the call option? Right to buy. So suppose an option holder is holding a call option for US dollar at say 73 rupees. And this option is met on due date. So this 73, what we call, this is called the strike price. The agreed price. Forward, we use the contracted or the booked rate. Here we call the term strike price. And suppose this contract, this option is maturing on say 15th of February 22. So this date we call the expiry date. So there are 2 terminology. One is the strike price, another is the expiry date. Now suppose strike price is 73. Now the due date has come. In the due date, that means 15th of February, the value of dollar can have three options, three situations. It can remain as 73, or it may be at 74, or it may be at 72. So what happens if on the execution date, means on the expiry date, the value of dollar remains at 73 and the customer wanted to execute? If
At
he
the money.
execute, there is neither profit nor loss, because what is the 73? 73 is the ruling rate on 15th February. That means on 15th February, this customer can buy this dollar from the market at 73. If we go to the bank to whom he has entered an option contract, there also he has to pay 73. So neither profit nor loss if we execute. So this option we call it is ATM.
At the money.
At the money. Now look at the second situation. The market rate is 74. That means if the customer wanted to buy from the market, he has to pay per dollar 74. But the strike price is 73. If he goes to the bank and execute the contract, the bank had undertaken, we will pay you at 73. Will he go to the bank and execute, or he buy from the market? He will execute because he is getting 1 rupee per dollar profit. So this is ITM. Okay, ITM. Now coming to the third one. See, the ruling rate, the spot rate on the expiry date is 72 rupees. What happened to the option? If we execute the option, that means he has to pay per dollar 73. Here from the market, he gets at 72. So he gets at a cheaper rate. Say, if he execute, he incur a loss, 1 rupee per dollar. If he doesn't execute, he will not incur that loss. So here, if we execute, this is loss. So we call it is OTM. Is it clear? So this is with respect to a call option. Now coming to the same situation, suppose it is a put option. Put option, strike price 73, and on due date, market
Sir,
price.
one doubt, sir. Sir, here buying is in the view of a customer, sir, not the bank.
Buy customer, right to buy customer, right to sell customer. Customer will buy, customer will sell. So who will enter a call option? Who will enter into a call option, exporter or importer?
Importer.
Importer, yes. A call option, an importer will execute. And a put option?
Exporter.
Yes, yes. Okay. So now here is a put option. And the strike price is 73. Now on the due date, ruling rate, the spot rate is also 73. What is the option? Neither profit nor loss. Put means right to sell.
At the money.
Right to sell. It is at the money. Now coming, if it is 74, what is it? Is it ITM?
No, it's OTM.
It is OTM. Yes, it is OTM. Here it is ITM. So this is the confusion most of you should have. So here, first you look at what is the option. If it's a call option, means it is a right. The customer has, the holder has got a right to buy. Whether it is foreign currency or it's a stock or it's a commodity, anything. The option contract you can have with the dollar, or you can have the option contract, the commodity.
Sir, in put option, here 74, you said it is OTM, but the customer is selling the dollar for 74 rupees. So profit for the customer, right?
You didn't understand the concept. See, the put option, the strike price is 73. That means the customer has got a right to sell at 73. Now the market rate is 74. That means if the customer goes to the market and sell off the dollar in the market, he gets 74, which is benefit for him.
If it is selling, it is
No. See, my question is, which is favorable? Whether he sell the dollar to the bank or he sell the dollar to the outside.
Sir, from outside, yeah.
Outside. So here favorable on what? If by executing a contract, if he is incurring a profit, it is ITM. If he is incurring a loss, it is OTM. That is all. See, if an option contract is favorable, it is ITM. If an option contract is not favorable, it is OTM. Is it clear? So much confusion.
Sir, in the Macmillan book, this ITM call option strike price is less than forward rate given, sir.
Pardon?
In the Macmillan book, sir, for the ITM call option, strike price is less than forward rate is given.
No. I don't think. I have the book.
Sir, that is correct. But what Sir was explaining is that connecting to market, not to forward rate. Suppose, sir, let me take 1 minute, sir.
Okay.
See, here in this call, in this case, Sir has explained that the call option is to be booked at 73. The Macmillan book says, suppose the forward rate for a forward sale contract rate is 73 rupees 10 paise, and the option market, if it is available at 73, then it is in the money. That is what Macmillan says. Sir, our James sir related to the market price on the maturity rate, that is the difference. Okay, Macmillan also is correct only. What he is saying, you are having an exposure to sell. Two markets are available. Forward market is there, option market is there. Forward market it is 73.05. Option market is 73. So Macmillan says if the option market is less than forward, it is in the money. That's all. Okay, the concept what sir is exactly the right. Okay, sir. Thank you.
Okay.
Thank you, sir.
Okay. So this concept, make it. I will prepared in the slide. Let me share it.
Sir, in the case of at the money, whatever we have paid as an option premium upfront, that will not be considered.
It will not be considered. It will not be counted for calculating whether it is ITM or OTM or ATM. The premium means the price of the option. That is not taken into account. That is different. For calculating the profitability, you can consider the premium or price of the cost of the option. Okay. So call option, put option, I have given option writer, who is option holder, strike price, everything I explained. Now there are two concepts. One is its intrinsic value and what is its time value. That also they can, because the option premium has got two components. Because I told you there is enormous risk for the option seller or option writer, and there is no risk for the option holder. Because if it is favorable, he execute, otherwise he will not execute. So therefore, enormous risk for the option writer or the option seller. Therefore, what the banker will do, banker will go for a premium, means a price. Whenever a contract, an option contract is booked, unlike a forward contract, there they don't collect any premium. Here, an amount is collected upfront that we call the option premium. So remember, this premium has nothing to do with the foreign exchange rate premium. This premium means it is the price of the option or it is the cost of the option. So that amount, just like in term loan as a banker, if you sanction a 10 crore term loan and the sanction term says 0.1%, you have to calculate as upfront fee, isn't it? Processing fee. So you, at the time of executing the option, this premium will be collected, and that will take care of if any loss incur into the bank on a later date when the customer is not executing the option. So remember, option premium is the price of the option or the cost of the option, or you can say the charge or the commission or whatever it may be levied by the bank at the time of executing the option contract. So it has got two components. One is its intrinsic value, another is its time value. And what is intrinsic value? Difference between strike price and current market price. Remember, only ITM option will have intrinsic value because it cannot be negative. Intrinsic value cannot be negative. So this intrinsic value will have only for ITM option. For OTM and ATM, intrinsic value will not be there. Next is time value. Time value is option price minus intrinsic value. So option price minus intrinsic value. If intrinsic value is nil, then what is time value? Option price. So these two things remember. And now look at this example. Rohit is holding a call option on a stock that is currently trading at 78. So the option is a call option. And now the spot rate is 78, means present rate is 78. If the strike price of the option is 75 and the option premium is 5 rupees, what is the intrinsic value? So I told you, look at the formula. What is the intrinsic value? Intrinsic value, difference between strike price and current market price. Here, what's the strike price? Strike price is 75 and market price is 78. So 78 minus 75, 3 rupees. So 3 rupees is the intrinsic value. And what is the time value? Time value is equal to option premium minus intrinsic value. What is option premium? It is given the strike price of the option 75 and the option premium is 5 rupees. That means option premium per stock is 5 rupees. Per one share is 5 rupees. Therefore, the time value is 5 rupees minus 3, that is 2 rupees. Look at the second situation.
Time value is option premium minus intrinsic value. In the previous slide, it was written option price minus intrinsic value.
Same thing, option premium and option price one and the same thing. I was repeating the option premium and option price one and the same thing.
Okay.
A put option at a strike price of 105 is currently trading at 100 rupees. So this is a put option. Put option means right to sell. Strike price 105. Trading in the market at 100. If the option premium is 3 rupees, find its intrinsic value and time value. Intrinsic value, strike price minus market price, 105 minus 100 is equal to 5 rupees. And time value, how do you calculate time value? Option premium minus intrinsic value. Here the option premium is 3 rupees, but the intrinsic value is 5 rupees. So there is no time value because time value cannot be negative. The time value or intrinsic value cannot be negative. Therefore, in this case, the time value is 0. Look at third example. A call option on a stock price at a strike price of rupees 500 is currently trading at 450. If the option premium is 10 rupees per share, find the intrinsic value and time value. Here, call option means right to buy. Strike price 500. Current market price 450. What's the option then? Is it ATM or ITM or OTM? Strike, it's a call option.
OTM.
It is OTM. So there is no intrinsic value. Intrinsic value is not there. Intrinsic value is there only for ITM. So therefore it is 0. Current market price minus strike price means you will get negative. So it cannot be negative. So intrinsic value is 0. And what is the time value? Option premium minus intrinsic value. That means 10 minus 0, 10 rupees.
Sir, second question. One more time.
Sir, what is strike price exactly, sir?
Pardon?
Strike price.
Strike price means the contracted rate.
So second example, how is the time value 0?
Time value, what is time value? This time value and intrinsic value cannot be negative. Here the time value is option, the formula is option premium minus intrinsic value. Option premium is 3 rupees and intrinsic value is 5 rupees. So 3 minus 5 means minus 2. It cannot be. So it is 0. That I have written in the bracket. Time value can't be negative. Similarly,
sir, question number 3, sir.
A call option. It is a call option. Call option means right to buy. Strike price is 500, but market it is traded at 450. That means if the customer exercise, he has to pay 500 rupees per share. If he buys from the market, he gets at 450. So this option is, if he execute, it is loss. So it is OTM. So OTM means there is no intrinsic value. So intrinsic value is 0.
So strike price is like the forward rate booking, huh?
Exactly. I told you in the beginning, strike price is nothing but the booked rate. Booked rate. Contracted
not
rate.
the normal rate, not the normal rate.
No, normal rate means the current rate or spot rate.
Spot rate.
Yes.
Sir, previous slide, sir. Previous slide.
Why, sir, minus 50 will be not there in.
It cannot be negative. No. What is this? The option premium has got two components. One is time value, another is intrinsic value. What is option premium? The charges paid by the option holder to the bank. And that cannot be negative. So therefore, this two component cannot be negative. It will be, if it is negative, you can take it as 0. That's why in some cases, time value will be 0. And in some cases, intrinsic value also will be 0.
Instant value and time value cannot be negative. Both.
Time value cannot be negative.
Value cannot be negative.
Cannot be negative. So this slide will help you, but I don't, may not be possible for you to remember all the greater than, less than. What I written in the down, you take care. ITM means if the option is favorable, it is ITM. If the option is unfavorable, it is OT. You by heart that principle. What is an ITM? By executing an option contract, if he is gaining or if he is getting a profit, it is ITM. By executing a contract, if he is incurring a loss, it is OTM. Okay. This is an example I given. Call option, the contracted rate 72. Two situations, 71 or 74. Similarly, put option 71, 74. Like that, I have explained in the whiteboard. Same thing only. You can, to make it very clear, I have given this slide. We'll move on to another example for option. Suppose A enter into a call option to buy $1 lakh at Indian rupees 74 per dollar after 3 months. Option premium is 25 paise per dollar. On expiry date of the market, on expiry date, the market rate of USD is 75. What is the profit or loss to the option holder? So the value of the contract is $1 lakh and the strike price is 74. And on due date, the price is 75. Here it is a call option. Call option means a right to buy. That means what? The customer has got a right to go to the bank and ask for $1 lakh, and the bank will pay $1 lakh at 74 rupees. But in the market, if he wanted $1 lakh, he has to pay 75 rupees per dollar. So what is the option? It is favorable to the money, or it is in the money. So the option is in the money. Now, what is the net profit? Here, for calculating the profitability, you have to account the premium also. Got it? So what is the price per dollar? 74 is the contracted rate or strike price, plus he has to pay 0.25 as premium. So 0.25 per dollar. So $1 will fetch 74.25. So what is the profit? 75 minus 74.25 means 0.75. Or altogether, he gets a profit of 75,000 rupees. Am I clear?
Yes, sir.
Yes, sir.
Yes, sir.
Very simple thing. So only for calculating the profitability, you have to look at the premium. Otherwise, for classifying whether it is ITM or OTM or ATM, you need not account the profitability. Suppose this one, 74 rupees, 0.25 is the premium. On market rate is say 74.25. What happens? Market rate is 74.25. Again, what is the profit? There is no profit. But what is the
loss of 25,000?
ATM.
What is the type of ATM?
ITM
Only the strike price.
It is ITM only because strike price is 74, market price is 74.25. Still, it is ITM because strike price is less than the market price, isn't it? But regarding profitability, he has got no profit. That's a different thing. If you account, yes.
50,000, sir.
Yes, sir.
Pardon? Pardon?
Profit is 50,000.
Which one?
You
This
told
one.
us, sir, 7.25 in that one, sir.
74.25. 74.25. Market rate is 74.25. What is his profit? If he executes, how?
Zero, sir. Zero.
Zero. Profit is zero because 74 rupees he has paid, 0.25 paid as premium. So totally he has paid 74.25. And now in the market also it is 74.25. So no profit.
Okay, sir. In this question, I think.
We'll move on to futures. Again, the futures is similar to forward, or you can say option, but some basic difference. In future, this is a standardized amount. Here the amount and the date are standardized. Whereas in the case of forward or option, the customer can fix when it is maturing and when this is, what is the amount. But in the case of futures, it's not like that. It is a standardized amount. $1,000, that is one future, or 1,000 GBP, one future, or 1,000 euro, one future, or 1 lakh yen, that is one future. Like that, it is a standard, just like our currency note, 500 rupees note, like that. This is a standardized, amount is standardized. You cannot break it. That is one difference. And the second is, in the case of option, it is option to the customer. Option holder can, if he wanted, he can execute otherwise. But this is not applicable in the case of futures. It is binding. So if somebody buys a future, then they have to execute it. Okay. Now, future is a derivative, and it's an exchange traded derivative. So this has to be routed through an exchange, a futures exchange. So that is a basic difference. Otherwise, futures and option is nothing but it's a future contract. It is just like forward in all respect, but there are certain basic differences. Now look at a question. A futures contract of 1 million USD is traded in the Nasdaq Futures Exchange for delivery on 30th of January at SGD 1.30. That means here the future says, this particular futures contract means $1 million will be delivered on 30th of January at 1.3 Singapore dollar. So per dollar, the other person has to give 1.3 Singapore dollar and get 1 USD. This is the contract. Now the due date has come. On 30th January is the due date. 30th January, the rate becomes 1.31. What is the profit or loss to the holder? So the futures contract will be sold by some firm, and that is traded in the market. And this has been purchased by a person. So a person is holding this contract. This futures contract is holding a person, and he has to deliver it on 30th of January. The who has sold it, he has to deliver $1 lakh and get 1.3 Singapore dollar per dollar. Now the due date has come. 1 million, not 1 lakh, 1 million. Now the due date has come. And on due date, the value of dollar becomes 1.31. What happened to the option holder? No, not option holder, the person who is holding the futures contract, whether he is incurring a profit or a loss. Here he is incurring a profit because the contract says, the person who had sold the futures says that I will give you $1 million at 1.3 Singapore dollar. So per Singapore dollar 1.3. What he will do? He will buy $1 million and sell it in the market. He get per dollar 1.31 because it is trading the market on 1.31. So therefore, the difference amount is given as profit. They need not, that is the case of futures. In the case of futures, either they can take the delivery or they can go for the difference amount. The profit per US dollar is 0.01 Singapore dollar. So the aggregate profit is 0.01 into 1 million Singapore dollar, 10,000. Now, second situation, on due date, suppose the value of dollar becomes 1.29 Singapore dollar. Then what happens to the option futures holder? He will incur a loss of 10,000 Singapore dollar. With this, we will wind up.
James, sir. I have one doubt, sir. Regarding cross mechanism, sir.
Cross rate mechanism. Okay.
Yes, sir. Sir, one doubt is this. That cross rate, if INR is given, we are taking equation number 1.
Sir, problems on CRR.
Individual. In case of division.
CRR and SLR, that comes under, sir, problems under, it will be in ABM only, no?
No, normally it will be asked in the economics. economics paper CRS SLR calculation normally will be asked, giving
So
the
come in the
details.
module D. So come in
Uh,
module D.
Module D.
Module D in the evening.
Mohanty sir will explain.
Yes, yes.
James sir, please cross-rate.
Cross-rate, fine. Cross-rate I will explain. When do
Only
we?
division portion.
Yes,
Only division portion.
Okay. I'll discuss both. See,
Doubt is this, sir. Once INR is given, sir. Once INR is given, then there is no problem. The equation number 1 we can tell. But when INR is not given, four currencies are different from INR. Then how to calculate?
Can you give me that question? Can you tell me what are the rates given?
Any rate, sir, any rate you take, but not in INR.
I will tell you, sir, one rate.
1 second, and let me explain. See, there are two situations.
One example in the morning we have doubt, sir. In that one, can you explain, sir? It's the same one only what he is asking, sir.
Which example? Which?
JPY 100.
Pardon. Tell me the question.
JPY is in hundreds. Means it's 1 JPY equals to 100. It is traded in GBP.
JPY GBP. Okay.
100 units. 0.6412. 0.6412. Selling rate is 0.6414, sir.
Okay.
0.6414.
Okay.
USD, JPY 114.63.
No, it's not the problem. This is the same cross multiplication. It's a multiplication. There's no problem, sir. And division.
Let me explain. Then you come out with your problem. Okay. Or you just post me in the WhatsApp group. I will take it from that if you have the question.
Regarding sir, INR is not there. Suppose JPY, Canadian dollar, or anything is there.
I'll tell you. Wait. See, you are discussing about situation 2. That means the common currency is on the same side. That means it can be USD, say GBP, and USD, SGD. Am I correct?
Yes, sir, you are right, sir.
So this.
So how is situation 1?
Yes. So this is, say, suppose USD GBPY is 0.7576, and USD SGD is 1.7374, something like that.
And we want SGD GBP.
Pardon?
We want SGD GBP rate.
Okay. You want the SGD
GBP.
Okay. Now look at this. Suppose this is equation number 1 and this is equation number 2. If we want the SGD by GBP, so SGD should come in the numerator. That means 1/2 gives USD by GBP divided by USD by SGD. Am I correct? This gives USD by GBP into SGD by USD. USD get cancelled. You get SGD by GBP. What's the confusion?
Confusion is, sir, when we are taking the rate for SGD GBP, suppose buying rate we are telling, so we have to take the buying rate and divide it by the selling rate of second. No?
Like, suppose you want the buying rate, equation number 1, what is the buying rate? 0.75 by
divided by
1.74. If you want the selling rate, numerator the selling rate 0.76 by 1.73.
Okay, and second, sir, suppose we want GBP by SGD.
Then it is 2/1.
2/1, no?
2/1.
Right.
Okay.
Whatever you want, we can put anything like this. No?
Yes.
Sir, please solve.
Sir, one more out, sir. Why we are not taking? We are taking SGD, USD SGD. Why we are not taking equation 1?
Pardon? Why we are not?
We are given, suppose first equation is USD over SGD. It is 1.73 or 74. First equation is given. Second is given USD GBP is 0.75/76.
then it is 1/2.
Okay, that is 1/2.
Okay.
I agree with you, but I'm asking this one. Which equation is to be taken as equation number 1?
Anyone you can take. There is no question of numbering. The one you take, the first pair you take as 1, second pair you take as 2. Then what we wanted? Suppose we wanted SGD GBP. That means in the numerator should be SGD. So numerator SGD means the second has to, you have to reverse, isn't it? I like that you think.
But problem will be there in suppose we are taking the buying rate. And if we are doing this USD SGD as equation 1.
No, it will not change. It will not change.
Sir, we are taking the buying rate.
His question is why 1.73 not divided by 0.76.
I am telling it's equation number 1. So you just change the equation, sir.
His question is 0.75 divided by 1.74. Why did not be 1.73 by divided by 0.76?
If you are doing the USD SGD,
you will not get the answer. You will not get the answer. That is the thing. Because, wait. In cross rate mechanism, I have very clearly given you the thumb rules. If you are having that PPT with you, you take. See, the thumb rule says there are 2 situations. Number 1 is common currency, opposite side. Here, the rule is multiplication. So multiplication for buying rate, multiply the buying rates, and for selling rate, multiply the selling rate. This is the rule, first situation. And second situation, common currency, same side. So same side here, you want, if you want the buying rate, numerator buying rate, denominator selling rate. And if you want the selling rate, numerator selling rate, and denominator buying rate. So
I know, sir. This is totally related, sir.
Yes.
The problem is this equation 1 and 2.
Let me.
Sir, one question,
I will explain.
One question, sir.
Okay.
So please resolve one question, sir. Just for
just wait, let's be clear first.
Cross rate, see, I have to take the arithmetic.
No, any number you can take, sir. Any number you take.
Sir, one question you can take, sir.
Okay.
Sir.
Okay.
I will tell, sir, USD by SGD.
Okay, one second, sir. Tell me, sir. USD
by SGD. 1.15, 1.20, bar 20. USD by JPY, 89.90. Now we want, see here the confusion why they are having, see denominator and numerator coming. See, finally, what pair you want to get? If you want to get JPY SGD, so sir, what 1/2 it will be working. And if you want SGD by that matters mainly here. Okay, sir. Now you can, if you want JPY by SGD, you calculate, sir.
I'll calculate. See, the 2 situations. Suppose you want JPY by SGD. That means numerator is JPY. You want the JPY in the numerator. Here, the 2 currency pair, here in the second currency pair, JPY is in the denominator. This you wanted in the numerator. That means, suppose you name this as equation number 1. I am naming this as equation number 1 and this as equation number 2. So how do you get JPY in the numerator? You have to divide 2 with 1. That means equation 2 means USD by SGD divided by USD by JPY. This gives you USD by SGD into JPY by USD. Sorry. USD get cancelled. You will get JPY by SGD. Fine. Suppose you want SGD by JPY. That means you want SGD in the numerator and JPY in the denominator. So it is 1 divided by 2. That means 1. What is 1? USD by JPY divided by 2. USD by SGD gives you USD by JPY into SGD by USD. USD get cancelled. You will get SGD by JPY. There is no, suppose you name this as
buying rate of JPY, SGD.
Oh, okay. But instead of this, I am putting this as 1 and I am putting this as 2. What the confusion? Then here, this becomes, instead of 2 by 1 becomes 1 by 2.
Convert into hundreds, sir.
Rate confuses, sir. Rate. Which buying rate
That is a different issue. That is a different issue. $1 is equal to, they have given it in Japanese yen only, 1 unit. Because when we quote, before 100 units, we quote. But this is quotation there, it is given.
The rate now. Buying rate of
Sir,
JPY,
can you tell the rates along with the rates?
Buying rate of JPY, SGD.
Buying rate of JPY, SGD. JPY, SGD. This is the one. See here, if you want the buying rate is equal to numerator. You take the buying rate of 2. What is the 2? The first one, the buying rate of 2 is 1.15, and denominator selling rate of 1. Selling rate of 1 is 90.
Now it's clear, sir. Clear. 2 and 1. Now the equation is clear, sir. Buying rate of 2.
Yes.
Sir, that was only 2, sir.
Yes.
1 equal to USD of something, sir. They are reverse, sir. 1 USD means how many requirement that's one?
Which one? 1 USD?
Sir, 1 JPY is equal to USD they are giving, sir. And they are asking 1 USD is how many JPY? They are asking reverse, sir.
Reverse. You might see, you want the selling rate or buying rate? What rate you want?
Both rates they are find out at last.
I'll explain. It's a very simple thing. Suppose you are given USD by JPY as 89.90. You want JPY USD. You have to, it is 1 by 90 divided by
1 by 90.
Yes. See, the reciprocal of selling rate by reciprocal of buying rate. Got it? Here, the selling rate is 90. Take its reciprocal, right on the buying rate side. Then 89, this is a buying rate. It's reciprocal as the selling rate. Am I clear?
Yes, sir. This one is at last. I think. Sir, open position and short position also known, sir.
Open position.
Sir, undo, sir.
Yes, sir.
Pardon?
Problem, sir.
1 second, undo, sir.
See, very simple thing. See, I have given you, see, direct rate and indirect rate, what's the relationship? 1 by direct rate is indirect rate, and 1 by indirect rate is direct rate. So here JPY USD JPY is given. We want the JPY USD. The only thing is it's reciprocal, but remember the selling rate reciprocal should come as the buying rate, and the reciprocal of buying rate will be the selling rate. That point you have to remember.
So one more thing, sir. Suppose JPY is given, it is always to be taken as 100 JPY, or they will tell.
If the rate is given in terms of Indian rupee, because this guideline is FEDI guideline, and FEDI guideline is applicable only for India. And for other countries, this FEDI guideline will not apply. There it is on JPY. They are given this USD JPY means $1 is equal to 89 JPY. But if JPY INR is given here, the code means it is 100 JPY.
It is 100 JPY. Okay, sir.
Now, open position. See, there are two open position. One is long, another is short. Long means overbought, and short means oversold. So, see, you know, the banks are doing lot of transactions every day, and say a particular day, on a particular day when they closes their business, their USD purchase is coming to say 10 million and USD sale is 8 million. So what's closing? When they close the books, what is the position? The position means there can be two positions. One it is open, another it is square. What is square? Square means both purchase and sale are equal. Just like our income in a month is 1 lakh and your expenditure also 1 lakh means it's a square position, isn't it? But if it is over expenditure or saving, that similarly in a particular day, when they closes the business, their total purchase, aggregate purchase of dollar is 10 million and aggregate purchase of sale of dollar is 8 million. What is the net position? It is over purchase or overbought. How much? Overbought by 2 million. So this is long. The position is long by 2 million. Now, so another situation, they have purchased 10 million and they have sold 15 million. Because see, for a squaring, see, they do the transaction, even spot transaction, they get 2 times for settlement, because the spot means the settlement can take place on the second working day. Therefore, they can have more than what they have purchased. So they have purchased only 10, but they have sold 15. So, and that means here it is oversold. And oversold, the position is by 5 million. So this is short by 5 million. And this has to be squared up next day.
Sir, one problem is there. I will share you.
What is it?
1 minute, sir.
What's up? Which group?
Sir.
Or your personal number?
Yes, 1 minute, sir. I'll be sharing.
Regarding FCNR? Is it FCNR?
Position, sir, about the position. Sir, I'll share in group, sir.
Which group?
CAIIB morning English batch, sir. May I read the question, sir?
As of 31st March 2020, the outstanding Forex open position of a bank is 400 crores, whereas the limit set for the position is 500 crores. What is the applicable capital charge? This position as per RBI Basel II. Basel II norm and all, Mohanty sir will explain. Basel II, I'm not well conversant with Basel II norms. And here, what's the open position? Open position, you can very clearly see open position. Here it is outstanding open position is 400, whereas the limit set is 500. Limit set is 500. So there is no provision is required. It is within the limit only.
No, sir. Actually, she may be asking about the capital adequacy ratio to be made. Capital charge.
For 400 crores, they have to.
500 crores, sir. No, see, for the open limit, what is the net overnight open position limit? Irrespective of the position, we have to maintain capital charge for the limit, but it will not be the limit. The question is wrong because now, so there will be a credit conversion factor. With that, we will be converting that limit, and then only we are fixing creating that capital charge. Okay. So here, since it is the credit conversion factor is not given, you take 500, and for that 500 you have to. The answer will be 45. Okay.
Sir, 45 is answer, sir. But how we will get this one?
500 into 9%, 45.
So the position is 500, sir. Our position is
limit,
500.
You have to take the limit, as sir was telling.
See, this capital charge is not for the proposition held; it is for the limit fixed.
Limit fixed.
500.
Okay,
so cross rate. Same currency on the same side means we have to intermultiply and divide.
No. Same currency on the same side means division. Common currency on the opposite side, it is multiplication.
But the cross side, you have to take the selling and the buying rate, buying and the selling rate.
No. Multiplication, it is both buying rates. If you want buying rate, multiply the two buying rates.
Can you please put it in the table, sir?
One second. You want the opposite side, isn't it?
Both. If currency on the same side, currency on the opposite side.
Okay. See, type 1, currency, same side. An example, USD, GBP, and USD, SGD. This is equation number 1. This is equation number 2. If you want, say GBP by SGD, you want GBP on the numerator and SGD on the denominator. So it is 2 by 1. And that means if you want buying rate of 2 by selling rate of 1. If you want SGD by GBP, it is, see, SGD in the numerator and GBP in the denominator. So this should be 1 by 2. So here, if you want the buying rate, it is buying rate of 1 by selling rate of 2. If you want the selling rate, it is selling rate of 1 by buying rate of 2. Similarly, here, if you want selling rate, it is selling rate of 2 by buying rate of 1. Now coming second situation, opposite side. That means the rule is multiplication. Here it is division. So example, USD, GBP, and GBP, SGD. This is 1, this is 2. Here, buying rate is equal to buying rate of 1 into buying rate of 2. Selling rate is equal to selling rate of 1 into selling rate of 2. But instead, suppose the question is, you want SGD by GBP. Isn't it?
Yes, sir.
Suppose you want, this is USD by SGD. Suppose you want SGD by GBP. You calculate this, then you take the reciprocal. Got it? As I told you earlier, no? You want an example?
Yes, sir.
Suppose the question is USD GBP is equal to 0.75, 0.76, GBP SGD is equal to okay, 1.9192. Common currency, this is equation number 1. This is equation number 2. Now the two currency pair. One currency pair is, suppose you want USD by SGD. Here you have to multiply 1 with 2. That means if you want buying rate of 1, 0.75 into buying rate of 2, 1.91. If you want selling rate of 1, 0.76 into selling rate of 2, 1.92. Fine. Now suppose you want SGD by USD. Now this is USD SGD. So what you have to do? 1 divided by the selling rate will be the buying rate, and 1 divided by the buying rate will be the selling rate. This is equal to buying rate will be 1 divided by 0.76 into 1.92, and the selling rate will be the reciprocal of 0.75 into 1.91. Clear? Is it clear?
Yes, sir.
Thank you.
Can I rub it? Clear? Can I clear it? Any other question?
Last question, sir. Tell me the worst case, sir.
Worst case. See, worst case means for an exporter. See, suppose you got, suppose the spot rate for USD in terms of INR is say 72 rupees. And overnight war is 50 paise. This means what? This means at some confidence level, say 99% confidence level. That means the next day when the business open, the value of dollar can be either 72.50 or it can be 71.50. That means the prediction says today the value of dollar is 72. Tomorrow it may go maximum up to 72.50 or minimum up to 71.50. That is the concept of war. War 50 paise means this is the meaning. Now, for an exporter, there is an exporter. For an exporter in this options, which is the worst case? Exporter means he's giving you dollar and he wanted Indian rupee. Which is more favorable to him and which is the worst case? Per dollar 72.50 or per dollar 71.50?
So he want dollar. So he want to buy the dollar, sir.
Exporter.
Exporter will want to.
You tell me, exporter wanted to buy or exporter wanted to sell?
Selling the dollar.
No, tomorrow you are going to write the exam. You don't know export and import. It means the basics. Very sorry, state of affairs. Exporter means you are an exporter means a firm or a person who is selling goods abroad. If he sells goods abroad, the price will come in the form of foreign exchange to him. So he is giving foreign exchange to the bank. He is selling foreign exchange to the bank, or bank is buying foreign exchange. From if you attended my class, the first one I was told you, exporter means as a banker's point of view, it is a buying transaction. Import for a banker's point of view, it is a selling transaction. Make it very clear. So here it is a buying transaction, exporter, which is the worst case. 72.50 per dollar or 71.50 per dollar?
$71.5, sir.
Yes, exactly. That's all. Similarly, importer. Importer means he has to pay per dollar. So which is the worst case in the case of an importer?
$72.5.
72.50. That's all.
Oh, sir.
Okay.
Thank you, sir.
Thank you, sir. Thank you so much.
Okay. Can we stop here?
Yes, sir.
Okay.
Thank you.
Thank you very much.
Okay. All the best. All the best to all
Thank
the
you so much,
participants.
sir.
Be very cool. Don't be tensed. Be very cool. Tomorrow there is a Telegram session I will be attending from 6 to 7 1 hour. Those who can attend, please.
Morning or in the
In
evening,
the
sir?
morning or evening, sir?
Morning only. 2 days over. 2 days Ramesh sir had taken Monday and Tuesday. Wednesday and Thursday I had been there in the Telegram group 6 to 7. And tomorrow from 6 a.m. to 7 a.m. in the morning, I'll be there in the Telegram group.
Thank you, sir. Thank you so much.
Okay. All the best.
Thank you so much.
Thank you very much, sir. Thank you.
Okay. Bye. Good night. Take care. Prepare well. Don't be tensed. Attend the exam in a cool way, cool manner.
Yes, sir.